there's a difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of like stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. Like that's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, you know, good win-loss. When you win more than what you lose. I mean, you know, when you have good metrics, by all means maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money, let me go and buy some flat price.
Bakary, thanks for doing this. I know you hate this kind of stuff, but
very uncomfortable. Well, gonna have to deal with it.
We'll just start with a quick fire round. You know, probably quite a lot of people do know you in the Dubai market. That's where you trade. That's where you traded for about 10 years now. But you know, as it is with the industry, like there's all these niches, right? So summarizing it, your career been how long in oil trading?
Since 2015, end of 2015, so that takes us right about the 10-year mark.
Yeah, and always been Dubai crude really in oil.
So when I started off, I did the usual kind of rotations.
Yeah.
It took me a bit to find my niche. So I traded a little bit of fuel, a little bit of brief period in naphtha, distillates, but I always kind of found my way back to Dubai.
You started with me, right?
Yeah.
Yeah, it was good times. And you always used to get shit for not marking your curve at the back. It was just not really your style. Chimming in and out. So I guess before we get into like more the detail, just summarizing, like how would you, and I know this has evolved, but if you had to very quickly summarize your trading philosophy.
So in terms of how I trade, so I trade, especially now, predominantly systematically. So all of my trading is very process-based. That wasn't always the case. Let's say 5 years ago, there was a lot more room for discretionary trading in the market, for day trading in general. As the market has evolved, I've also kind of moved a little bit towards slightly longer term, more signal-based trading. So I'd probably say I trade medium-term momentum with a variety of signals based on flows. So, you know, just understanding why and how people trade to hedge different kinds of risk, different kinds of books, and that helps me, kind of guides me through the ebb and flow of the market on a day-to-day basis.
So very much trading as a trader rather than like, you know, always been about oil and oil specifics. You were at JP Morgan before, right?
Yes, so I started my career at JP Morgan, actually with their credit trading team in London. So I did that for 3 years. That was my first job. And then eventually moved on. So that was very much a classic bank derivatives market making role. Yeah, and then 3 years later I moved on to Mandara.
Cool. So when did you first realize you want to be a trader?
Well, at university, I was doing my bachelor's in economics and management. So I was remotely interested in understanding economies and businesses. I've always liked playing games, video games, board games, anything like that. So in my mind back then, the job that would combine those three things seemed to be trading.
Grad scheme thing.
Yeah, so the process back then, if you wanted to go into trading, you applied to internships, the summer internships. So I did that, applied everywhere, got into JP, did that in the summer of my second year, got the offer to come back after I graduated for the full-time grad scheme. And yeah, that was the start really.
Okay, so favorite trading book?
Ooh. Probably the one that had the most impact is a book called Mastering the Trade by this guy called John Carter, I think.
Got it over
John
there.
Carter.
Yeah.
Do you have it?
I think so, yeah.
It's a very good book. I really like it.
Quite niche, industry specific.
I mean, it's got nothing to do with oil. It was.
Sorry, when I say in the trading industry.
Yeah, for sure. I mean, the reason why is some of the ways in which it talks about coming up with trading strategies. I learned from that, even though it's completely about, like, I think the guy mainly traded S&Ps and things like that. And none of the strategies that he used are even remotely applicable to oil. The method, the way that he thought about coming up with strategies was very useful.
And so where are you most at home? And like, which asset class are you most at home in? From like analyzing, feeling like you know what's going on?
I really like oil. To be honest, my time at Credit, frankly, I didn't really understand much there. But oil is a lot
more tangible.
A lot more tangible, and I feel like I get the market a lot more.
Okay. Favorite trading film?
I don't even know about films. What's the series that came out? Internship?
Industry? Yeah.
Industry. Yeah.
Did you watch that?
I did watch it. I think honestly, in terms of describing and portraying the grad scheme, the internship kind of vibes, it's quite accurate.
Okay.
Apart from all the rowdy stuff.
Yeah. You sure? Okay.
At least I didn't do it.
Yeah. What's your most memorable market event that you've been a part of?
Oh, it has to be the start of probably the Russian-Ukrainian war.
Really? Okay. So kind of later on.
COVID before that, but I'd say they were, well, maybe COVID, just because apart from the market moves, there was also infrastructural change. We all moved to working from home, and one of those two. Yeah.
And if you weren't a trader, what do you think you'd do?
I don't know. It's a very tough question.
But I guess economics something still, right? So you enjoyed that.
I don't know. I think probably. It's hard to say because I like it would have to be something a bit more dynamic.
Like wrestling?
Who knows?
Because you're a passionate wrestler from my memory back in the day.
I trained jiu-jitsu.
Was it? No, but when we first met Mandara, you were into wrestling, no?
Yes, but now
we had
I
a few spars on the trading floor, if you remember.
Yeah. Maybe, who knows? I think I'm a bit too old.
And if you're aware of any nicknames, or what would if there was a trader nickname, do you know what it would be? No idea, right? The Stoic, something like that. Okay, so just last one. So if it was day trading or swing trading, what would you consider yourself?
Swing trading.
Swing trading, yeah, great. Thank you. All right, cool. So, yeah, I'd like to get more into, as you said, the JP Morgan credit time. And I think it's come up in conversations with us quite a lot. And I think for people listening, everyone has their different starts in oil. And I think it's kind of unusual, actually, given how niche this industry is, for people to come from the outside into oil. I think that's actually more of a rarity than a standard process. But do you think that macro element, it sounds like you say you're really into oil, but did that still guide your thinking as you entered, and still to this day you feel like you have to have a good grasp of the macroeconomics to guide yourself in oil?
So at first, yes, but that was a very incorrect way of thinking.
Okay.
I thought I had in terms of my grasp of macro was completely useless. Okay. So I think the time at JP Morgan was very good at teaching you, first of all, the basics of derivatives trading, the different types of products, more importantly, the concept of taking risk, warehousing it, and managing it. Because when you work there, or in fact for any big investment bank as a market maker, you're constantly showing prices. You're constantly having to make markets for your clients. You can't just one day say, oh, I don't understand what's going on. I'm just going to take it easy today and get my bearings, which is actually a luxury that I have now. So that teaches you a lot, and it's a lot of very painful lessons that you learn. But if you're able to think about and to analyze how how your decision making takes place in those different difficult moments, then there's a lot of learnings you can have. So for me, it's mainly the benefits came from understanding how to manage risk, how not to manage risk, the overall workflow, like the business of trading, the broader business of trading, you can learn a lot as well from that environment. It's a very good school.
I was going to
for
say
trading.
that. I mean, your learnings are really interesting, and we've actually talked. What we're trying to do at Onyx and what we were doing at Mandara before that, and what JP Morgan were doing. It does guide your trading, isn't it? Because like you're saying, when you were in the seat at JP Morgan, I guess the decision from management or what you were there to do was facilitate the franchise. That was the highest
Yes.
priority, right? And kind of
Yes.
money making was almost second.
If you were taking down all the flow and you weren't necessarily making a whole lot of money, as a junior guy for sure you'd be probably a superstar. Of course, the more senior you got, you also have to make money as well. But the way you would do that is through market making.
Yeah. And then pivoted to Mandara and even Onyx, as you say now, it's like, you're right, it's that luxury of saying, actually, we're kind of proprietary traders. We can go to trade and pick what we want to do. It found its way to being a market-making operation because that's where a lot of our trading and our risk profile was, until it became like a skill set and a franchise move to be doing that day in, day out, which is very much what you had the ultimate hold on in Dubai crude, because it's one curve, it's very difficult to market make. I did it myself for a long time, was figuring out after costs, I'm literally like break even here, it's a pain. And so to figure out how to reliably provide liquidity whilst also making money is actually a very difficult thing to do. And the evolution of that market has become like, well, actually there's no real market making, or market making or providing liquidity is a different thing now. It's like you're there to take risk OTC if needed, but chopping in and out is a screen-based thing now, right?
Very much so. And the funny thing is, when I was at JP, I hated market making. So
Okay.
in fact, that was, for me, my biggest challenge of my time at JP was the fact that I hated market making. It was completely foreign to my personality because I was, like back then, I was quite introverted. To some extent, I am still today, but I can manage it better now. But as a market maker, there's a lot of different stakeholders that you have to build relationships with, you have to manage. It's always noisy, it's chaotic. You can't just sit down.
I'm slightly laughing because I remember, like, I don't know, like 6 months in, you were a bit of a character, right? Yeah, I know you're introverted, but you're also like confident, right? And we do still a lot of pit trading. So
Yes.
just games like betting on IMDb ratings or whatever it was. And we were just encouraged to get in a room and just train, I guess. And then you were very much like, I'm going to make a market. I'm here. And I remember everyone tried to buy you and you were just like, so to everyone. Do you remember that?
Yes,
It's
yes.
hilarious. Like,
But I mean, the games is one side when you're actually doing it. Like, I didn't like it so much that I convinced myself by kind of the second year that I'm never going to do market making. But the funny thing is, when I started trading Dubai at Mandara, I almost built like a market making business voluntarily. So I think
because you could see there was an edge in it, essentially.
because there was a demand for it, but largely because you could find a process and a methodology to run risk, but then you could trade that risk, those positions around as a market maker. Now, market making there wasn't the same thing. You weren't constantly showing two ways or anything. You were just providing and taking liquidity at different points in time when that was required. You weren't constantly on the market, showing two ways.
That's a big thing for us as well, isn't it? It's like, can you show me a two-way? And I always used to hate that question. Like, no, I'll show you, like, if I can counter. These days, and again, I
That's
think
the norm.
That's the norm, yeah. Show me a two-way. Okay, fine, here it is.
That's how it used to be. Like, that's a very classic question when you're a trader at a bank as well, and you have to. You then have to guess, okay, what are they going to do? Skew the market based on that, skew the market based on what your own position is and what you want to do.
Where you're comfortable, yeah.
It becomes a slightly different. But the problem is when you're doing that all day long, you don't really have that much time or space to zoom out and to think about, well, what is the market actually doing? Which position do I actually want to have? You're stuck in that loop of taking risk off the back of what you see is going on, which is fine depending on which market you're trading. But a lot of the time, you really need that space to zoom out and to build your trading strategies, to build how you want to actually run risk. If there was no market, if you didn't know who's doing what do you want to do? That was quite hard.
That's a great segue into my next question, which is 2024 and certainly 2025, I think unilaterally has been considered difficult trading conditions. Yet you've had a good year, and you've never really had a bad year, let's be honest. But it's one of those things where the numbers would probably make it seem like you've got some like system going on, and you're just like, yeah. But there's a lot of iterations and evolutions, more importantly. And I think that must come into your philosophy and approach to trading, right? Always be reinventing, or at least trying to have a kind of anti-fragile approach to trading, which kind of comes back to the first bit that you just said. It's like, what do you want to do? And if you can't start there, then you're at the mercy of the market, really, of which there are a lot of traders who are essentially at the mercy of the market beta or the market paying the bid offer or whatever, right?
Very much so. I mean, you're right, because and that's the most difficult part. You know, the market will, in my memory, for however long I've been trading Dubai, it changes at least once a year, maybe several times a year, the whole paradigm of what's driving the market, even how the market trades. I'm not talking about things where how the screen has become dominant and all those new algorithms that are running on the screen. That's a whole separate discussion. But the market will always change with varying frequency, and while my core methodology of trading hasn't changed, I've had to constantly reshape it and adapt it to the new market. And then you absolutely have to, because otherwise you'll be left behind.
So are you thinking ahead for that, or are you just looking at maximizing what you have at the time, and when it stops working, you kind of start again?
Yeah, I'd love to be able to think ahead, but I can't. So when what I have is working, I try to maximize that, and then you inevitably hit a rough patch. And that's always a very tricky part, because let's say you have a set of strategies, and in the back test they perform, but they will inevitably they don't always make money, right? They're going to make money, there's going to be a period where they lose money or they plateau, and you're going to have some sort of hopefully positive equity curve with a bit of volatility. It's always hard to know whether your rough patch now is within the normal parameters of the system, or your strategies are becoming obsolete. So usually, there's something that you expect within the backtest. When you're approaching the limits to that, that's when you start thinking, okay, are we in a changing paradigm? Do we need to start kind of thinking about how to change this? It's always very tricky. But generally, I will typically hit a patch where, okay, it's just not going right. Maybe I'm not losing money, but I'm plateauing. And then you have to then make a conscious decision. Okay, does that mean the way I think about the market is no longer valid? If so, let's iterate, let's think what we can change.
What's really interesting there for me, again, is the kind of general, I think, way people trade and apply themselves versus the way I think you do it quite differently is you are looking at your system, what do you call them, the parameters first, and you're saying, this is my VAR, this is my drawdown, this is what I think the market can give me with these strategies, and that's where I'm going to maximize. You're not one of those traders that goes, well, if I can make 5, I can make 50, I can make 500. If you don't mind saying, you've been approached by the bigger firms who've said, come and like scale, how can you make, 100 million? And you're like, well, that's actually changing everything. That changes everything I do, and
Yeah, because there is some scalability. Well, there is a scalability of any strat. Well, okay. The more short-term a strategy is, the harder it is to scale it, because it depends on faster movements. The longer term your strategy is, the more scalable it should, in theory, become, but also the more P&L volatility you have to be prepared to warehouse. So there's always that trade-off. So yes, if somebody tells me, okay, can you 10 up your risk now? Sure, but that's going to bring about more problems with getting in and out of positions. That's going to, in fact, probably I don't think I can 10x the position. I could probably triple it. Beyond that, the metrics start, well, even by then, the metrics probably start to deteriorate. But there's always that sweet spot, that balance, where it's not just saying, oh, I'm going to increase the size. No, your metrics are going to deteriorate.
Well, I think that's where you deserve credit, because basically you haven't allowed yourself to get away with it and run away with it. Like, again, you said COVID and 22 to 23 kind of time, great market conditions in the sense of a lot of beta and market moves, and generally people were making money. and we've seen it ourselves in our own trading floor, sometimes that allows people to believe that they've got this limitless approach. They're not really factoring in the what do you call it, the restrictions that the market might give you down the line. So I think your ability to not get too high with the highs is something you deserve credit for. But I think also that is kind of unusual because you're I don't know, mid-30s, whatever. You're not that new to it, but at the same time, it's not like you've been decades and decades and you've always been like this. So I think there's an element of natural maturity there. But is that something you think you've consciously, is that something that's in your personality to be like, well, look, let's not get too ahead of ourselves. There could be downtime, there could be bad times around the corner type thing.
To some extent. I also, the way that I look at trading is not, it's very, very remote from gambling. So for me, the way I look at trading is, like, I'm not sure if a game is the right word for that. More like there's a business and you're executing your business plan. And in your business plan, what is it? It's your trading strategies. It's the risk framework around that. I don't then all of a sudden go and put on random discretion. I might, if there's a good opportunity, I might put a discretionary trade on with the right risk controls over it. But generally, the work I do is in building the strategies, and then it's fairly easy. I just execute them. So if the parameters of the strategy dictate a certain optimal size, then that's what I trade. Now, it would be amazing to come up with strategies that allow you to put on bigger size, maybe move out a little bit towards the longer end of your horizon that you hold a position for. It would be amazing. But it's also not so easy to do. So you're constantly trying to come up with things that would allow you to do that. So my restriction is not in saying, oh, I restrict myself. It's more that you trade what you've come up with, what you've backtested, what makes sense, and you trade it in the optimal size. Hopefully you come up with something that allows you to scale up, maybe another strategy. If you could do that, great, amazing. But if you can't, that doesn't mean that you should say, oh, I really want to make, some big numbers. Let me just push my current strategy beyond the optimal size, hoping that it makes more money, because that doesn't make sense from a business standpoint.
You're seeing yourself as a business. And ultimately, if you were to, okay, why haven't you been as tempted, or have you been tempted to try and join some of these firms, I guess, with huge risk appetite, wanting to see you make 200-300 million? Or has it just been something that
you can do if there is an appropriate strategy? So,
but if someone forced you to look, mate, I just don't care what happens, I want you to try and make that money, you would then say, look, that's gambling.
I think at this stage, maybe at that point I would start thinking, who knows where the creative process takes you. Maybe there would be strategies that would pop into my mind. I don't know what would happen. But as of right now, I'd probably say, yeah, sure, of course I can try. But we're going beyond kind of strategic trading. We're going towards the realm of gambling.
Which doesn't really interest you?
No. I don't view trading that way. And
is that, what I'm trying to get at is that you're saying it's very logical, but you gotta admit, like, there's a lot of people who fall foul to the ego side of things, which you haven't. So what is going on there? Is that something consciously you've been aware of, or?
Yes, I mean, to be honest, I'll give you an example. When I started off, I wasn't like this. When I started off, probably during my time at JP Morgan, I was constantly falling to. Look, a simple thing would be you're getting hit or lifted in something, and then you run that position because you're hoping it goes in your favor, without any rationale, without any real reason. You don't take a step back to think, okay, but do we actually want that position? What is your actual kind of view? Is the trade that you've just been lifted in something, do you want to be short there or not? Do you want to be short in general? Do you want to be short at that price over a short time horizon? None of that thinking would be there. It would just be, oh, I got lifted, let's try and buy it back a little bit lower. And then of course, it proceeds to go above, and you're sat there thinking, well, this market making is not for me. I hate it. I'm an amazing trader, but the market making is terrible. Whereas, in fact, you're a terrible trader, right? You're just.
But in that example, though, if we was take it now, and someone was like, "Look, I just need you to fill me in something like $5,000, something big," and you didn't want to sell, but you needed to show an offer, you would still take a positive expected value approach to that, right?
No, now it's different. Now I will show you, like, okay, but probably 5 years later, 5 to 6 years later after that, no, I will show you a price on whatever you want, and it will be the right, in my mind, the right price. So there will always be a correct price for your volume. It might not be the price you like, but it's a price that I like and I'm comfortable with.
Yeah, but that's interesting, isn't it? Because like you're saying, do I want this risk? Essentially, no. But is there a price that actually
Yes.
this gets into realms of is acceptable?
Yes.
But then if you lose money on that, what do you are you thinking? If I get left on this, these are my outs, these are my hedges, this is my potential drawdown. Yeah.
Exactly. So you transact at a price that there has to be a reason why you think that's a valid price. It's not just that you take a price out of the sky. So you must think, okay, if I can't get it, I mean, if it's a huge deal, you're not going to be able to get out straight away. You must believe that if you warehouse that deal, there's a way that you can hedge that in some proxy way until an offsetting risk presents itself that you can de-risk.
But in a scenario where you're quite keen to be long, let's just say, and you're forced to be short quite a bit of size, is there just a scenario where you say, look, I just don't want to do it? And that is the ultimate fail-safe.
So for me right now, yeah, of course, all the time.
Yeah.
Back then,
No.
not really.
Okay.
Because when you have clients rather than counterparties, you do have an obligation to provide a price.
But then what about the obligation you have to your business, which is I want to be the guy people go to so I can get those trades. Sometimes it might not work out, but I want someone to make the call.
So the obligation to your business is to be long-term profitable for the business. Being the guy that people come to is part of long-term profitability, but if it comes at the expense of you pissing away money here and there and not being able to recover it meaningfully in any way, then I think you are not working in favor of your business. So you have to be a little bit thoughtful here. Everyone will, at any point in time, there's 10 guys lined up willing to trade something super tight just to get the deal. That's not really what this is about, right? If you have a process how you're able to quote, tight prices, that's separate. But a lot of the time you will have people who will come in and they just want to get the deal done. Okay, great. How long are you going to be able to do that? Right? So I've done this for a little bit, and I've seen people come and go. And the process repeats itself. So you need to think long-term. You need to be long-term profitable. If you are in the realm of liquidity provision, you need to probably be a type of counterparty that is long-term reliable for either sizable liquidity or liquidity when things are difficult. Because when times are easy, again, there's going to be a lot of people prepared to offer liquidity. When times get tough, that's not the case. That's where you can provide value to the market by showing thoughtful prices and right prices. That's how I would think about it.
Makes a lot of sense. So what do you think, getting on like the lessons learned, when you have a particularly hard time, do you find enjoyment in basically reflecting and saying, okay, there's something for me to calibrate, or do you allow kind of do you ever get into that fear thinking of like, is this all never going to work again? Or is there an underlying confidence that you'll find something always? Or do you ever struggle with these kind of things?
Always.
Okay.
Like, I'm not a fan of this like fashionable, I love being challenged. I hate being challenged. What am I, a masochist? No. Like, I want life to be easy.
Okay.
So, yes, it's always hard as we mentioned before, when you are in that tricky period where you're either drawing or you've not been making money for a while, and you're thinking, what does that mean? Does that mean my system is wrong, or does that mean we're still within the acceptable parameters? That that can become quite tough because you always have these thoughts. Okay, well, that's it then. This is finished. But you have to. If you need to take a step back, whether that means take a few days off or just go on holiday to clear your mind, come back, maybe look at things from fresh, do that. If you need to stop trading, go read a book, go just do something that maybe shifts your perspective, go do that. But there has to be a way for you to maybe like find inspiration to find a way out.
But you have an underlying confidence that in bleak uncertainty, there will be something that reveals itself at some point.
I think confidence comes from doing something over and over. So luckily, I'm happy that I've been able to do it every year for a number of years. Maybe next year, maybe in 5 years, I won't be able to do that anymore. But for now, I've done it a number of years, 7, 10 years, and so far it has worked.
But if you wanted an easy life, you could have done easier things.
No, but this is an easy thing. This is a very, you mean other jobs?
Well, you said I don't like to be challenged, whatever, but you've taken, like, the Dubai curve is horrible. Like,
yes.
No one ever wanted to trade that. Like, being a crude market maker, which has obviously always been my thing, you just like, that market is shit. Like, why would you want that challenge? But you took it on, right?
True. I think the reasoning there was because everything else was already taken. And I'm like, okay, I want to trade.
But you got to go on gasoline and things like that.
Yeah, but then there were guys already in line.
Okay.
And I was like, I want to trade something on my own.
Okay.
The only thing is, Dubai was never even a separate desk.
Yeah.
So I went and said, okay, this little curve, split it for me. I'm going to trade it.
Yeah.
Okay, that's interesting, but that's it's not really a challenge when you have nothing and you're starting from zero.
But I think what you're saying, aren't you, is that if you're talking about your values, you do value independence then quite highly.
Yes.
Yeah. So that supersedes your want to have an easy life, right?
Yes, my best time, again, and for instance, if I compare my time at a bank versus at a proprietary trading company, it's like night and day. At a bank, you are part of a team. There's structures. You have to deal with salespeople, with your MD, with your immediate boss, with different other traders, and you have to do stuff. Whereas in a prop trading company, you don't.
No.
They give you that leeway to breathe and to find your niche.
Yeah, I don't know. I mean, again, I think there's things that sometimes work against, and obviously everyone has this, like you want this, but then that, and you kind of have to compromise to the position where you're comfortable with what you have.
Sure.
Because I would say, from what you're saying, you're independent and you want to be left alone, and to some degree that's true, but you've always trained traders. You've probably got one of the best training records, and you must have some enjoyment from that.
Yeah, that doesn't bother me though, because if I had to, what would bother me is if I was, so I'll give you an example. In the however many years I've been here, since 22, like over 3 years, you've never once come to me and said, oh, what's this risk on the book you got? Neither you nor Omar. I do what I do. No one's ever even asked me a question. Right? That approach. Now, again, you must have your reasons for that. There must be some kind of reason for that. But that's more what I'm talking about. I'm not against, training people or collaborating, sharing knowledge. That's slightly different. It's more about I am responsible for my own performance, and I like that to be the case.
Well, I guess I was just trying to take it. There's another part of this, which is, I think you do like to be part of a team as well, right? And you do like to train, and there's something in your career you've valued as well.
Yes, but I like to be responsible for my own performance.
Yeah.
That's the thing. I don't like to be in a situation where my performance also depends on someone else in part.
And in turn, that means, of course, you believe in the meritocracy angle, right? I mean, there's probably infuriating for people like yourself, which I don't think there's that many on a percentage basis, but who then get treated like they're in some pool. It's like, you get the benefits of being independent as well as the downsides. So when you suddenly change that and say, oh, we're going to rope you in with this collective thing, it's like, but then that's not how that's not the deal I signed up to. And I imagine that's something that has been important here and probably your previous place as well, and then maybe other places couldn't offer, and it's something we maybe need to. I mean, certainly I love working with those people, and it's just, I'm kind of talking out loud because I want to protect that mindset, because the alternative is you get born into a franchise and you have to really believe in the franchise first and whatever else, but you're kind of taking handouts.
No, but there are some areas of the business that do require a team approach, right? So that's a little bit different. But you also, if you're going to be going into that area, you need to almost have the mindset where you're happy with that, right? Like obviously if you take like a very introverted kind of secluded person, you drop them in there, that might be a bit problematic.
Yeah.
But it depends. Like for a trader, you could do fine on your own, unless again you're in such an operation that really requires a multiple, many people on the team to be able to push the operation forward. So it really depends what kind of business you're in.
I think moving now to more specifics in oil trading, I guess something that I think you must have mentioned to me before in the past is we've been part of this evolution of the market moving from a very physical dominated mentality to more flow driven financial, and that only seems to be going one way, and it's pivoted from us being kind of bit part players to very much in the mix of what's driving prices. But I guess because you've gone from that journey, you did need to, and I guess you still respect the physical pricing and what people are capable of doing, but you've never had the physical. So that is a weird dichotomy, isn't it? So how would you explain why that's been comfortable? I think that's surprising to people, by the way. How can you guys be proprietary trading, especially in the spot market of Dubai crude? Like, there's so much going on there that requires inside information, flow information that, well, people would think that, but clearly you've been able to get information more second, even third hand, and still been able to filter it into your derivative trading strategy and make it work, which I think is surprising to people.
I think it's almost like there's different games being played. So what players who have access to physical, the game they play is wildly different from what you would do as a derivatives only player, right? So if you have access to physical, that access, your ability to market barrels and to buy and sell barrels gives you information. It gives you real information on supply demand for any given cycle, not just supply demand balances. Okay, it gives you real information. It allows you to take paper positions that you can then, you leverage your physical capabilities to make something work. Okay, that's something that we can't do. And that's not really a game that a derivatives only place can ever play. Sure, you can put different pieces of the puzzle together and you can figure out, okay, most likely this is what is going on, so we can position it. You can do that, yes. But again, your ability to manage that will be limited because most of those things tend to happen, for instance, as we know, in some of the very prompt contracts. And the liquidity there, if you look at BAMO, is not going to be, if you're wrong, unlike a physical shop, you won't be able to get out. So you need to be careful about the risk reward there. That, however, you have the whole rest of the curve, which is, yes, when it becomes prompt, becomes set by physical, but there's a lot of time until then. And so that's where I have personally focused my efforts, right? So there's a niche kind of medium-term horizon where there isn't that much competition. Well, people express views there, but there's not that much competition in the sense of somebody doing a trade does not prevent me from doing that trade. Whereas if you're trading the front, it does.
So you're almost trying to take the benefits of what physical pricing can do to the derivative market whilst not being too invested in it and herd trading it, whilst also doing exactly the same with the derivative market.
Or sometimes, the other parts of the curve can be disconnected from physical, and they can be driven by their own
But that's what I'm saying, trying to take the best of both worlds.
Yes, you try. I mean, really, you try and take whatever comes your way, but you try to be mindful of where your real edge is.
So how much do you think about the actual players that you're trading against? Do you worry about their psychology, think about their psychology, or you try and stay away from that?
Back in the day, so probably 2018 until probably 2024, that used to be quite important. The reason is simply to understand. So look, even let's say I trade quite systematically now, so I barely even day trade. Back then it was different because even if you were a systematic trader, first of all, liquidity wasn't so granular that you could meaningfully test strategies against, or let's say you get a signal, does it mean you can get in at that price or not? So back then you had to work intraday quite significantly to be able to just get in and out of positions. And if you are going to trade intraday, you have to understand who is doing what to get a good picture of the different liquidity pockets. If you are a buyer, what do? Do you go and start lifting offers? Well, then you're going to push the market away, by 20 cents by the time you're done. But you might know that there's a particular counterparty that comes in the afternoon to do a hedge. And you're going to wait until they do, and when they do, you're going to trade with them at value. And that way, you're going to execute into the position that you want, that you had a signal on, I don't know, in the morning. That's why it was very important. Now, the dynamic of the market has changed to the extent, well, there's a lot more going on the screen. You still need, in a healthy market, to be clued up and to be aware of what's going on OTC, because more often than not, people execute large orders OTC, right? So you still need to know that. But I think it's much less so now.
Well, that was my next question. So yeah, Dubai is overnight almost, seemingly. Sometimes you think like it's very screen driven, but you still have a broker market, you still have OTC trading. And a lot of these guys are playing the screen versus the OTC, and there's always that element to it. So the next couple years, not even that far out, is it going to, well, how do you see it playing out, the dynamics?
I think probably, look, the trend, it's an interesting question. So a little while ago, we probably always thought that everything would eventually go to the screen, much like Brent futures did back in the day when they moved from the floor to the electronic trading. But electronic trading also has some downsides. When you start, electronic trading makes the market a lot faster and more volatile, and we've seen that. If you have people making markets in an algorithmic way, if you have a lot of high-frequency traders, for instance, making markets on the screen, any move can get augmented, and moves in one direction or another can cascade without a whole lot of trading happening in between.
And make you think something's going on. And
it might make you think whatever, but the market, without much going on, the market can gap around a lot. You have our own version of the flash crash or something like this, and that now happens fairly frequently. At some point, and I mean you have this probably if you look at equities, right, which were electronic for a while. You do have things like the emergence of or increasing popularization of dark pools, where people are like, well, hang on a second, I want to get a big block done, so I'm going to go into this dark pool and I'm going to try to get it done quietly, if possible. I don't know whether at some point people will get tired of the increasing volatility, and they might say, well, okay, that's fine for small size or whatever, but if we want to actually execute big size with reducing the footprint, or actually, with getting a meaningful price, maybe you'll see a move back to some sort of hybrid model where some of the bigger tickets are executed still direct or through.
But I think that is still. I mean, we were hiring a trader in the US who all his trading is block futures. There's still a big enough OTC market.
While there is a screen?
It's the Brent futures, it's RBOB and all that. Right. And it's exactly what you're saying. It's like, rather than be part of that noise, I'm going to get a reliable person who could be roundabout there and no footprint. And you can see the value in that, but you need to then know you can rely on that person, and I guess they make their own assumptions of that.
Yeah.
But I see a logic, and so I think that's, maybe something not to be afraid of, in the sense like there is a liquidity dynamic even from broker perspective that will probably retain for quite some time.
Yes, and I mean, in any case, you do need to, you can't really see the future, but you can only take it as it comes, and you have to adapt to that. So if the market is becoming more, faster, maybe you need to slow down.
Yeah.
Right? Yeah. You need to slow down your own decision making, and rather than taking data at such granular levels, maybe you just look at the market on a day-to-day basis. You know, there's many things that you can try to counteract that.
And
Good morning, folks, and welcome to another Singapore Market on Close episode. The mood is good everywhere. So let's start with the US. We had the government shutdown. It was finally agreed that the government restarts from today, and the mood is also good in Dubai. As we can see here on the chart, trading activity increased significantly. BP stepped out as the main seller, and Trafi was the main buyer as usual. So as we can see here, BP and Trafi, BP declared actually 2 upper Zakam cargoes to Trafigura, and then Phillips and Vitol also declared to Trafi a cargo of upper Zakam each to too. Now, Sinochem also declared 1 to Totsa, so it was a busy window. According to our calculations, BP exchange sold at least 28 partials to Trafi, so it was a very active window. And if we look here at the Dubai physical premium on our chart, we remain on the same level, around the 75-cent dollar mark, around these areas, which is pretty depressed. Calendar spreads remain very depressed everywhere. Dubai physical premium, as we can see here, 75 cents. That's the lowest in almost a month that we saw yesterday, and remains pretty subdued. Brent spreads are low. WTI spreads are trading flat or even in contango in the more deferred months. So we need to see how this evolves, because that's very significant news. Now, if we move elsewhere into price action, Brent Dubai, as we can see on the charts, it was the activity was it was trading range bound around minus 78 cents to minus 84 cents, but flat price has been declining throughout the morning session. So we are now in the mid to low $62 level. We've came down a lot compared to the $65 level, as we can see here on the charts. And that's pretty significant. One talk about it is gas oil, of course, and as we can see here all the way down on the Flux terminal as well, gas oil is at least $2 down compared to yesterday. So why is that? Basically, we're hearing from sources that China is about to grant to refiners an additional 6 million barrels of clean petroleum product exports on their quotas. So that means more gasoline, more gas oil, and more jet fuel to be exported from China by swapping them with the low sulfur fuel oil quotas. So that's bearish for the market, and gas oil reacted. Refiners are enjoying those margins. Gas oil has been rallying over the previous sessions and remains pretty elevated, but this is some good news relative to price action, which should come down even further. That's it for today. Join us on the European Market on Close, and until then, please keep in touch on the Twitter, LinkedIn, and our Flux news channel. Thank you very much.
Hello, welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. Welcome to the UK Energy Show. So, this week we're talking about COP. COP30 got underway in Brazil with a clarion call from the hosts. We need roadmaps, they say, which will enable humankind in a fair and planned manner to overcome its dependence on fossil fuels, halt and reverse deforestation, and mobilise resources to achieve those goals. We'll discuss what's been discussed in Brazil so far. Also this week, diesel prices are on the rise again, particularly at the pump in your town. Why should that be when the world has a glut of crude oil? And never mind the future, wind power has already saved the UK over £100 billion. We hear from a former market trader turned academic. That's all a bit later on. Joining me to discuss this week's events, Julian Keats from the Flux markets. Julian, welcome to you. Let's get into some of the news of the week, shall we? COP30. Now, COP30 is the United Nations Climate Change Conference. It takes place in Brazil from the 10th to the 21st of November this year. These climate change conferences take place every year. They're the world's only multilateral decision-making forum on climate change that brings together almost every country on Earth.
And it's great to have the head of state so committed with this COP. And I believe this was a really wonderful opening session. Then I have to thank here in front of all of you all the delegations for the fantastic agreement that they reached regarding the agenda yesterday night, late at night. And this agreement is, I believe, going not only to allow us to start working today already very intensively, but it will also allow us to explain to the world why these additional issues that had been raised really matter.
That's a clip from the opening press conference. So, Julian, let's talk about COP. Let's go back.
Yeah.
What are they all about?
Yeah, I think that's a really important place to start. So just think COP30, as it's often referred to, COP29 last year. It's the 30th annual United Nations Climate Change Conference. And it's taking place, as you said, it started on Monday and it runs all the way through to the 21st of November. So roughly 2 weeks. And it typically, right at the end, it doesn't always end on the date that they think it's going to end because there's a bit of wrangling and gerrymandering and deciding actually what's going to be achieved and announced. So on and around the 21st of this month, and as you say, Belém, which of course is the gateway to the Amazon. So this year, hosted in Brazil, and I'm sure they've chosen that site for a specific reason, deforestation, so on and so forth. So this global summit brings together nearly 195 countries, the world's countries together. Okay, collectively, they're going to negotiate and advance climate action, aiming to limit global warming and adapt to climate impacts, whatever might be happening. And of course, this just in the last few weeks, we've had Jamaica, the hurricane there, the strongest hurricane ever landing in the Atlantic basin. Okay, so again, climate activists would say that's absolutely down to climate change. The Conference of Parties, COP, Conference of Parties, is the main decision-making body, okay, for the UN framework of Convention on Climate Change, UNFCCC, which was established back in 1992. So it's been running for a long, long time, and they created a global framework to address climate change and impacts. So COP30 builds on 30 years of climate negotiations, including landmark agreements like the 1997 Kyoto Protocol, which had some real issues in being able to allow countries to agree because it was a more draconian approach. You will do this. So actually, the Paris Agreement that's often referred to, 2015, COP 21, I think it was, that decided that actually we would lead this on an individual country basis, NDCs, and allow countries to decide what they're going to do, and actually celebrate the UK. The UK really embraced that, in actual fact, and has led the charge. I believe. Okay, so that's a really positive thing for the UK. We should congratulate ourselves about that. And what's this all about, the Paris Agreement specifically? It's about limiting, and you can see on the screen here, limiting climate change from pre-industrial levels. That's 1850 to 1900. Climate change annual temperature changes to 1.5 degrees to 2 degrees, somewhere between that range. And as you can see on the chart here, and we'll play it over the course as we're discussing COP30 here, at the moment, we really are threatening 1.5 to 2 degrees. And this is, the limit is due, that maximum limit is due by 2030. We want to limit climate change below 2 degrees come 2030.
But that ambition, which was set, as you said, and reiterated many times, looks like it's going to miss the target. As a globe, we're going to miss the target.
Yeah, some people say, because it's a 10-year average, so we're not 10 years beyond, of course. Yeah. So, you know, and climate change, we have spikes and in terms of temperature and reductions as well, as predicted by climate change scientists. So we're not really there to say, you know, undeniably we have breached it, but it does look like last year was the warmest year on record. So what are we going to do about it? That's the key thing, really.
Yeah. What are you hearing from your colleagues and the market generally about the Americans not being there? I mean, we know Donald Trump is a climate, if not a denier. He's not a fan of climate change. Absolutely. He doesn't really believe in it. He's not sending a delegation. Does that really matter?
Yeah, I think it does send a signal to people that are in that camp. And, you know, I can understand why we've really benefited, and we'll hear from Colm O'Shea later, right? We've really benefited from what I call low rent energy. Very, very relatively cheap energy, right? And the reality is that that should we want to reduce our emissions, we need to build different infrastructure, and that has a cost to it, of course. So with Donald Trump not being there, actually the US Senator for California, Gary Newsom, is at Berlin.
And he's very concerned.
And he's very concerned, of course. Yeah. And of course, he's making a political statement, of course, by doing this. And I personally believe we're in a transition, right? So we need to think about both. We need to be sensible with our policy, and we'll hear this from Colm O'Shea as well. We need to be really sensible how we enact and transition, because policy, as we're going to see, as we discussed today, really does impact the price. And this show's about affordability. So we really want to do things in a sensible way, because actually, when we see that spiral on the screen just now, it's really intangible, isn't it? Okay, if I was in Jamaica, it wouldn't be intangible.
We can acknowledge it. It's knowing what to do about it, isn't it? Okay.
Yes.
Let me bring you right to our second talking point this week, which is here in the UK, as we record this show, we're still 2 weeks out from our budget.
Yeah.
But I've never known a budget with more speculation about what a chancellor will or will not do. What's the buzz around energy and what it's going to cost you and me as consumers? Are you hearing anything?
Yeah, absolutely. And we've got on screen here the FT's response or prediction that Rachel Reeves is going to very seriously look at bringing energy bills down. And again, I think it's very important. Energy bills at the moment, the tariff, the price cap for energy bills is around about £1,700 per annum for electricity and heating for a standard 3-bedroom house in this country. That is almost double what it was 15, 20 years ago. That really is important. It's politically important. It's important for individuals. It's unaffordable. So,
and a portion of that is tax, right? Which is her thing. So she does have a lever she can pull. Make it worse, make it better.
Yep, absolutely.
By a measure.
Absolutely. And I think...
What's your sense, Julian? Is she going to do it or not?
I think she will cut back VAT, because Labour's big mandate is to run the renewables, because long term it should be cheaper, but in the near term we've seen costs come in to the bill. So VAT, I think, will be reduced. And I think green levies will be reduced. And if we think about VAT on that £1,700, that's about £90 a year, right? So that's not insignificant. And then the green levies are around about £170 a year. So those two things combined, if she was to reduce them completely, and we're speculating here, that's £250. So we bring that price cap down effectively to £1,500 a year. So it's a substantial decrease, but it's not back to where we were 15 years ago.
Okay. Let's talk about diesel prices, shall we? Because right now, diesel prices are going higher at the pumps. I don't know if you've noticed, because they creep up, don't they, by a penny or two a week. Why is that going on? I thought there's lots of crude lying around the world.
Right, yeah, that's a really good question. So actually, as part of answering your question, let me just draw watchers, listeners to the slide we've got on the screen here. This is freely available on our website, and you can track your diesel prices and gasoline prices here in the UK at the pump price. And prices last week, the average price was £1.43 at the pump. On average, varies depending which pump you're going to, where you are in the United Kingdom, but on average, £1.43. At the moment, spot markets are around about £1.48 equivalent right now. And that price rise has been driven by a couple of things, I think. And it's always difficult to be absolutely definitive, but I think we're coming into winter. Winter is predicted to be very cold in the Northern Hemisphere this year.
Blame the meteorologists for that.
Yeah, we're going to blame the meteorologists for that. And you might also say, well, hang on a moment, you're just talking about global warming. Cold. But actually, global warming predicts that we'll have extreme changes as well as a trend upwards. Okay, so we're predicted to have a very cold winter this year. Who knows whether it will do, but that's had an impact to diesel prices, heating oil prices, because they're kind of very similar products. And the other key thing that we talked about last week and the week before, was the sanctions from the United States on Lukoil and Russian. And I think Greg was mentioning that's could be huge. And we're really seeing an impact on the cost of taking crude, refining that into diesel. And Lukoil has refineries in Eastern Europe, and those refineries currently aren't really selling anything. So you're finding that impact come through on diesel, and that's impacting on our diesel price here in the United Kingdom.
So
that's
the lever that's working there is the Trump sanctions, is it? It's affecting Lukoil, and that's affecting everyone.
And ostensibly they are impacting, if they are affecting this price, and it's a part of the price. I haven't said how much it is, I don't know.
Sure.
But it absolutely
These things have a
underlies
ripple effect, don't they?
Ripple effect.
Around the globe.
And what we want to add in, and Greg was saying two weeks ago, if these sanctions are really policed throughout the supply chain, and they're difficult to police that way, let's just balance that argument out. But if they are really effective, and history says they're not, right? But if they are really effective, we would start to see crude prices as well as diesel prices really escalate in value, possibly towards the $80, $90 a barrel mark. Now, I'm not saying that's going to happen. That's if policing really happens. History says they are not policed that closely.
This is the UK Energy Show, brought to you by Flux, the news, information and trading platform for world energy markets from Onyx Capital Group. Now next, wind power has saved the UK energy consumer billions of pounds over the last decade or so by reducing the cost of energy we use by over £100 billion. That is a bold claim in a new piece of research which has been co-authored by a former market trader and businessman, Colm O'Shea. Colm has recently concluded a master's degree looking at the impact of the UK's nascent wind power industry, and that's had on the price of fossil fuels, in particular, the price of gas. Now, his work is presently being peer-reviewed. It does make some surprising discoveries around the ROI of existing infrastructure. So I called up Colm and asked him if he thought the financial markets had this benefit factored in.
Financial markets like electricity markets, oil markets, gas markets, they're pretty smart. I mean, those are the kind of things they use to trade, and those kind of things work things out. Where you're talking about markets, meaning, is it good to invest in a wind company that builds turbines? That's a different kind of problem, because the big problem that I'd say the renewables sector faces is that there's a massive benefit to the renewables industry that doesn't go to the people who own renewables companies. It's like the opposite of tobacco. Like tobacco companies make loads of money, and unfortunately, other people get cancer, and other people pay for those healthcare costs. Wind's like that in reverse. Is the wind companies aren't making huge profits, but what they do is they stop us, prevent us paying much more than we need to in buying imported gas.
That rather turns the argument of people being against wind or against renewables, or believing that renewables are expensive and something is going to be a long way out of reach. It rather turns that argument on its head, doesn't it?
It does, but that's why I wanted to find out the answer, because I found these debates really frustrating to listen to, because what you'd have is a skeptical person talking about money, and then a person in favour generally talking about climate change. And I thought, those arguments don't reconcile. They're not talking about the same thing at all. If someone says, I think wind is really expensive, someone else should say, I agree, or I don't, and here's why. So I wanted to find that answer. And the answer I came up with, it means that it doesn't matter if you don't believe in net zero. It doesn't matter if you think climate change is a complete hoax. You still want to have wind energy because it's much cheaper than the alternative.
Yes, and we are, I think, I know it's stating perhaps an obvious point, but as an island nation on the edge of a vast ocean that's pretty windy, we are well placed to exploit this to our own advantage, aren't we?
Hugely. But I think the thing that confuses people, and probably used to confuse me, is someone of my age, gas has been cheap my entire life. So in the 1970s, you had all this cheap gas coming in from the North Sea. And so in the 1970s, we converted everyone's house to gas boilers. In the 90s, we converted all our power stations to gas because it's the cheap thing. It all comes to the North Sea. That's fantastic. And what people don't seem to realize is that we've kind of got it all now. I mean, we now extract 10% of what we used to. And that's just geology. So these are oil and gas fields in decline. We don't have that cheap energy anymore. Texas does. We don't live in Texas. So the local energy that's cheap, which used to be gas, now the local energy that's cheap is wind. And if you still want to have gas, you've got to go and get it from Texas. And that's really expensive.
And in doing your research to build up this case, this argument, you've just made the assertion that the North Sea is to all intents and purposes exhausted. What evidence did you find for that? Because you'll be aware there's still controversy over those who think we should carry on drilling because there's still more to get out of the North Sea. What's your view?
I think a lot of this debate about licenses is a total red herring. I mean, there is gas possibly like a mile down in the North Sea, but it's so expensive to get to it that no one's going to drill for it. So you can have a really hypothetical debate in a alternative reality where someone's going to drill for very expensive gas that no one's ever going to want to burn because it's ridiculously expensive. So if the gas that's easy to get at, we've got it. Norway still has some. That will also decline over the next decades. We are already importing lots of gas. Without wind, we'd be importing loads more gas. And a few licenses here or there for people that aren't ever actually going to drill for it creates a lot of political heat and a lot of anger and noise. But on both sides, I think it's just irrelevant.
And the fracking or shale gas story, did you look at that?
Yeah, it's really big in Texas. Yeah, if you watch Landman, it's really important. It doesn't mean, I don't think, Doncaster's going to turn into Texas. There is a debate about it, on heat on both sides, and I don't really want to express a strong opinion. I can see both points of view. What I'm really saying is it makes incredibly little difference to the cost of your gas bill and electricity bill, because best case, we're never going to get a lot of it. Gas, if there is cheap gas in the world, it's not here. And it costs an awful lot to move a gas halfway across the world.
A reflection that's probably outside the scope of your project, but if you'd like to venture a thought, please do. And that is the way the things have worked out at the moment. It is the electricity consumer that seems to be paying levy after levy after levy, making electricity more expensive to you and me in our homes. Gas prices go high enough, but then the government or the administrators of the day explain that that's because of all sorts of the gas consumptions and the point you've made about having less North Sea gas. Is it unfortunate, unfair, or just a necessary growing pain that electricity consumers are paying a heavy price just now?
I mean, it's totally counterproductive. It's policy that is contradictory. It makes absolutely no sense to pile all the taxes you can onto electricity bills, subsidize and the main thing you're doing in renewables is bring down gas bills. So you have this double whammy that electricity users are paying all the costs, gas users actually get all the benefits. And the big problem is you make electricity really expensive while saying that you want to electrify the economy. You know, if you want people to have heat pumps, make electricity cheaper. And what they're doing, they're making the bills really expensive. Those are political choices. They don't come out of the economics or the finances. There are lots of things being pushed onto people's bills just because, frankly, the government wants to raise as much tax as they can, and people have to pay their energy bills. And so it's a way to raise tax. It's not a way to build an efficient energy system.
Paul Moshe speaking to me a little earlier. Some interesting research. As he says, it's being peer reviewed. So the exact numbers may pose out, but he's making this essential point that actual fact, gas prices could have been a whole lot worse had it not been for the wind infrastructure that's gone in.
Yes, that's exactly the point he's making. And you know, I really like his research because he's trying to factor over a long period of time and restructuring any major product, any major sort of infrastructure change, you need to think about it over the long term.
Yeah.
And yeah, I think he's saying he's talking about geological depletion of the North Sea, that actually that is fact. We're not Texas, where we have, and there are various basins across the United States, not just Texas, where they are fracking cheap gas. That cheap gas does make its way to the United Kingdom through LNG imports.
Okay.
But LNG imports, as Colin says in his interview there with yourself, is that's extremely expensive. Actually, it kind of sets the UK gas price today. So it costs about 2.7 pence a kilowatt to bring in here equivalently. So that's exactly where gas prices are today, right? So that actually does already happen. So we're taking cheap gas from the US and importing it from here and from Norway and also from Qatar via LNG imports, Norway via a pipeline. So that is already helping our gas network. But as he says, we've avoided having to consume that gas because to produce wind, you just need freely available wind. There is no invoice to wind once you've built the farm, right? And that's really what
And he was at pains, as I was talking to him, to point out he's not actually a campaigner
No,
for either
not at
side
all.
in this. He's not pro
He's
oil.
impartial.
He's trying to be impartial as a piece of academic work. But it's interesting that maybe, and this is a sort of note to self really, as we go through this programme, that above that political noise and some real passions about the pros and cons of all this, quietly, engineers are getting on with problem solving, like how to optimise our wind in the British Isles.
Yes, and I think he makes a point. We've got a lot of abundant wind here. I think you actually raised the question, right? We're on the Atlantic. There's a big fetch.
Yeah.
We get sometimes we're very windy and probably likely to continue get more and more windy. So you know, yes, we've got that, but also we have. You know, he's talking exclusively about wind. And wind, if we do look at wind, offshore wind particularly, actually the current round of licensing to build new offshore wind is extremely expensive. It is more expensive than the current gas price. But will that stay the same long term?
It's one to watch for us.
It's one to watch.
And just an observation he made about policy. He was not getting political, but he was making a call to policy makers to make the right calls, wasn't he?
Yes, he was. And this is a really important factor. Actually, the real issues are in and around renewables, particularly in the power, the electricity renewable process, is that policy is a complex tapestry of sort of, we'll just tweak the policy here And that filters down to the UK household buyer of electricity. So we've not done anything with gas to heat homes because our homes aren't efficient. We've left that alone. Everything's built on the electricity price. And so actually what really needs review is a very deep system-wide policy review that's updated for where we are today and where we want to go. Right.
Next up, let's have a look at what's been said on our social media channels from people who've been watching the UK Energy Show. We've got, Julian, some commentary on the Lukoil story, which loops back. A comment here about Bulgaria has only got 35 days of gasoline and some 50 days of diesel. That's just one country. But it is related to this whole Lukoil shortage we were alluding to earlier.
Yes, absolutely. There's a refinery that Lukoil own that Lukoil are trying to sell their international assets as a result of the US sanctions. So, you know, of course, Bulgarians and Eastern Europe are impacted by that because if it's not being able to run, there's going to be a potential shortage of refined product. And, you know, this just highlights how important refining and oil is to running economies, traveling. It lubricates economies. It's so vastly critical in terms of the energy transition, in terms of mobilization, in terms of running an economy. So yeah, I can understand their worry. What I would say in response to that is, in my experience of 35 years in the oil market, it is incredibly good at adapting. So price changes and that brings in the required. Unfortunately, that will have an affordability impact.
Okay, let's just get your take on this next post here, which is from Claire Coutinho, who happens to be, as I'm sure you know, the Conservatives' lead spokesperson, the Shadow Secretary of State for Energy. Here she is having a pop at Ed Miliband. Now he's going to lock us into higher prices for decades. She's joining a Cut My Bills campaign. The political knockabout, which we were remarking earlier in the show is not particularly helpful, continues. Inevitable, I guess.
And let's face it, it is politically sensitive. It is sensitive to UK households, 30 million households in this country, hugely important. The two things I'd really say about that is that the FT article we were looking at earlier, if it is right in its speculation that Rachel Reeves will cut VAT and adjust green levies that are on the coming through on our electricity bills, that could save up to £250 per household per year. Okay, what I would say to that, now that would get us to the £300 here, right? Almost, not far off of it. It still leaves utility bills immensely higher than they used to be. And the other key thing here is, why are we having this budget run up with the most speculation ever? Because as a country, public finances are in a dire state after the credit crunch 15 years ago, after Brexit, after COVID. We have and austerity before it, which meant we weren't really investing in infrastructure that generates tax receipts. So we don't have enough tax income. How are we going to pay for this? Is my worry, right?
Well, in 2 weeks' time, we might get a better idea.
Yeah.
Thank you, Julian, very much indeed, and thank you indeed for watching the programme. Any thoughts on what we've had to say or our guests have had to say? Do add them in the comments underneath this video, wherever you're watching. We'll see you next week.
Hello and welcome to the latest episode of The Hedging Show. I'm joined as ever by Harry, and we've got Julian back with us this week.
Aren't you lucky?
So, this week, slight change of tack. So rather than talking about energy, we're going to be talking about FX risk, how you can hedge it, how you can measure it, how you can manage it. So I guess it's a sort of feature of many businesses, but it's not always a risk that people are necessarily aware of, or possibly one that sometimes people just think, okay, we'll just live with this risk because we can't really do loads about it. And I say when we're talking about FX risk, we probably most of the time mean exposure to the US dollar. So if your costs are in one currency and your revenues are in another currency, and that's particularly important in the commodities industry because almost all commodities are priced in dollars. Mm-hmm. And I suppose, we've all probably become more aware of currency strength in recent years, post-Brexit, as the pound has declined, we've noticed holidays becoming more expensive and, goods becoming more expensive because we import most of our inflation. But that's probably, been a fairly long-term trend over the last 20 years or so that the pound has been weakening. But I mean, at the start of this year, though, we have seen a little bit of strength. So I think, into the back end of last year, the pound was particularly weak. And then the start of 2025, we saw a sort of, 15-cent rally. And then ever since the kind of tariff news in April, we've been kind of moving fairly sort of sideways between a range of about 130 and 135. But I think that's certainly been one of the big themes of 2025, hasn't it? The kind of, de-dollarization and people not being so happy having exposure to the US dollar, which has traditionally been viewed as a safe haven.
Yeah. Just before we go on to that, there was something that you said at the start, which might be worth clarifying for the viewers. You said we import most of our inflation. Might worth clarifying.
That's right. So but because so many commodities, so the kind of raw inputs for whether it's food, whether it's energy prices, are all priced in dollars, it means that if the pound is weak, then the cost of those goods goes up. And because we're a net importer of food, we're a net importer of energy, we don't really have much control over the costs of those. And then the currency adds an additional dimension to that. So people in the US would have found themselves more insulated from the cost of living crisis, even though it's still being quite a big political football that's being kicked about. They would have been way more insulated from the kind of post-COVID, post-2022 cost of living crisis, because they used the US dollar and the dollar was strengthening throughout that period. And they've also got a lot of domestic production of food and energy. Whereas for the UK, it was a double whammy because the raw prices were going up, but the sterling adjusted prices were going up even more.
Yeah. Okay. Yeah, so de-dollarizing. Well, and I guess specifically in the energy markets, you've seen like a real, since the kind of Western sanctions started in the last few years against Russia, especially, there's been like an enormous narrative of this, like, well, again, de-dollarization, but a lot of global trade, especially in the East, kind of happening outside the Western financial system.
So worth noting as well that whenever you do a transaction in dollars, it always has to be routed back via the US. So if Iran wants to do a deal with Russia or China or something like that, they can't really do it in dollars. It has to, otherwise it will be routed via the US, and they'll be made aware of it.
Exactly. Yeah. So I actually got sent an article this morning, which was from a couple of weeks, in fact, maybe like a week ago. And it was the Russian finance minister said that like over 99% of their bilateral trade with China is now priced in rubles or yuan. And I mean, you've seen, there's been a lot of articles. I mean, people who follow kind of financial news and especially in the energy markets would have seen that like more and more you're seeing like India Indonesia, Brazil are transacting a lot with Russia and China in actually their native currencies, which, as I understand it, is quite a big boost for them, not having to kind of hold like large reserves of US dollars to transact and being able to just transact in their kind of domestic currency.
Yeah, no, I think that's huge, isn't it? Especially with all the kind of tariff disruption as well.
Yeah.
So I think historically it was probably less of a problem because all of those kind of Southeast Asian countries are sort of exporters, and they would have probably been running a dollar surplus.
Yeah.
So it probably wasn't a massive issue for them to then use those dollars to buy energy. But since Trump's effectively trying to reset that balance, they don't necessarily have so many dollars swishing around anymore.
And also, well, it's on one hand they get the oil's discounted anyway because Russia is just selling discounted oil because they need to keep it moving, but also being able to pay for it in your local currency as well and kind of circumnavigate the Western financial system for them. It makes it like much more efficient, and it's a big boost to the economy, basically buying cheap oil in your own currency, where they used to kind of have to go to the kind of open market and buy it in USD.
Yeah.
And also, if you're buying a lot of stuff from China, which most people are, if you can now kind of transact in energy in yuan as well, then it almost kind of makes more sense now that you hold just a big foreign reserve of Chinese yuan rather than US dollars.
Yeah, exactly. And then you kind of have to look at where you're investing those foreign reserves as well. I mean, kind of historically, people were quite happy to hold dollars as their main reserve currency, weren't they? Because, you could just plow that into US treasuries and that was seen as the kind of ultimate risk-free asset. Yeah. Whereas now with the kind of constant hiking of the debt ceiling and the kind of US government borrowing just going up and up and up, people are a bit nervous about holding US treasuries, and they'd probably be more comfortable holding Chinese bonds now, I would say.
And I think I pulled a stat for this, which was that the kind of foreign US treasuries held in custody, I think, is at the lowest level for like 15 years or something.
We should get a graph of that up because that's a really, and if you're selling those off, you're actually adding to US inflation, right? Interest rates are going up, their debt is increasing. Yeah. It really is exponentially compounding. It's kind of similar problem we've got here in the UK.
Exactly, with gilts where, you've got quantitative tightening going on.
Yes.
That's pushing yields higher. And then you've also got sort of lack of demand as well, which is just, it's a bit of a perfect storm, isn't it? But yeah.
And it's interesting, isn't it? Because this is not about Donald Trump and the US or the policies, but of course he's very keen for interest rates to go down, as we are here in the UK too, because public finances are out of control, right? And that hopefully that's going to get addressed shortly. But that it's really conflicting, and that lack of stability really is problematic now, isn't it? It really is.
And I think we should probably even do a whole other show about interest rate hedging.
Absolutely.
before we sort of fall down that rabbit hole.
Yeah, let's come out of that rabbit hole.
But yeah, I guess sort of in summary, it's been a major theme of this year, hasn't it?
Yes.
The kind of de-dollarization, weak US dollar generally, people looking to diversify away from the US, whether that's kind of rotating out of kind of tech stocks because there's a high valuations, not wanting to hold US treasuries, and obviously we've seen massive flows into gold. But obviously we kind of need to be cognizant that if you are investing in something like gold as a hedge against the US dollar, if that hedge itself is denominated in USD because it's an ETF, or if it's a gold future trading on COMEX or whatever, then you've still got that dollar exposure, and that's potentially going to water down your returns. But I think we'll go on to that in a little bit, where we've kind of got an example that illustrates that.
But yeah, just I suppose to summarize how it's in the energy markets, I think out of all kind of asset classes, energy's been where most of this, and oil specifically, has been where most of this kind of de-dollarization has been pronounced, especially because Russia's such a massive exporter of oil, and the East is kind of starting to transact in native currencies. That's been like an enormous theme, and like India joining in as well, like huge refining sector, them all kind of being willing to transact outside the US dollar system is like, it's a huge shift. It's like a real tectonic shift. And you kind of, I think Donald Trump's quite nervous about it, given he's kind of just constantly threatening new tariffs on, people for not using US dollars. And
Yeah, it's always been in the background, isn't it? I mean, I don't think dollar supremacy is about to end.
no.
Overnight, but it's definitely at risk, isn't
Yeah,
it?
it is.
And there's always been a keenness to move away. And maybe now this is the impetus to accelerate that,
Which I guess is what they're worried about, right? It's a bit of a house of cards situation where it kind of looks like the start might be quite slow, but then all of a sudden, if people don't see it as a kind of the safe haven it once was, then it can be quite exponential how it all unravels.
Yeah. You get into this sort of like doom loop, don't you?
Yeah.
I mean, I remember even sort of like 20 years ago, people were talking about the euro challenging the dollar's dominance, and then the kind of sort of post 2008 sovereign debt crisis kind of put pay to that, and it's probably only just kind of coming back now to the kind of safe haven status that's starting to look attractive again versus the US dollar. But I think that narrative is more about dollar weakness than kind of euro strength, isn't it?
I mean, the reality of the consumer market in the US is just so huge, isn't it? It really is. So I can't see it ending personally. It's just, it seems to have started a slippery slope, but maybe that changes, right? And let's not forget Western politics is always quite short-termist, isn't it? So it could all change in 3 years' time, right?
Yeah, I think that's a good point actually, because I think it's worth noting that people from all around the world invest in the US, whether that's holding US stocks or US bonds.
They really do, yes.
US people only invest in US assets. They got no interest whatsoever in owning kind of European stocks, foreign government bonds. They it's just not on their radar.
I just think about it this year, just again, not really related to what we were supposed to talk about, but the S&P return has been phenomenal this year, hasn't it? Which probably suggests there's a massive correction. Sorry.
But anyway, so I think that's a kind of good sort of geopolitical overview, and we've kind of highlighting the fact that there is FX risk out there. There's the chance that you will get significant moves, but it's all about risk tolerance, really. Some people, to some firms, a 10-cent move could be manageable. For others, a 1-cent move could be problematic. Going back to what we've discussed in previous shows, it's all about your margins, isn't it? And if they're wafer thin, then you're more sensitive. So I guess kind of going back to the topic of hedging, it's if you're a company or you're an individual even, it's first of all, are you aware that you even have this FX risk? And then where does that come from? It's we talked about this before. Just because you don't have a physical position that you can see, it doesn't mean that you don't have exposure, right? So going back, I think Onyx as a company is quite a good example of that, because obviously all of their revenue from trading activities would be in US dollars, but most of their costs would be in pounds. So that just gives them a natural short position in cable, because they're effectively long dollars and short pounds all of the time. And then how do you then kind of construct a hedge around that? Because some of those things might be quite easy to measure. Probably your cost base is probably quite stable and predictable, but your revenues might be a lot more volatile. And then also, you've got to think about, are you hedging against a specific timeline, whether that's, just you're hedging 12 months out, or are you hedging against a specific transaction? So you might get an example where, say a UK company wants to buy a company in Japan or something like that, so that they know that they're going to be doing a sterling yen transaction in 12 months time. So they know precisely what their yen exposure is, and they know precisely the length of time that they need to hedge. Whereas if you're a company like Onyx, for example, then you've almost got this requirement for a perpetual hedge, and the size of each leg might be kind of going up and down all the time. So it becomes a lot more.
You kind of don't really know till after the fact.
Function, right? Yeah.
But I think it's one of these things that
you just mentioned the word cable, and I just conscious that I don't actually know where that term came from. But when you mention cable, you mean US dollar versus
that's
sterling.
an interesting point. Yes, so that's kind of the industry term for pound versus the dollar.
Yeah.
And the reason it's called cable was because the first transatlantic cable that was laid was specifically laid so that it could transmit the FX rate back and forth across the Atlantic. So yeah, that's why it's called cable. And yeah, so interesting bit of that.
Just threw you off your flow there. Sorry,
no,
Tom.
that's fine. So I think kind of going back to what we were saying though, it's even if you've got a very complex FX exposure to manage, like we were saying, where it might be kind of perpetual, it might have different size or variable size on each leg. I think the first step along that journey is just being aware that you have it, isn't it? It's just recognizing that you have a position. And then it might be that you say, okay, we're just going to, risk accept that volatility in our earnings. But I think, the second natural step is, okay, well, how do we measure that? How do we measure the impact that it's having? And then we can then make a decision to say, are we okay with that? And if not, then the third step is, okay, well, how do we kind of, mitigate the impact of that?
Pools, yeah.
And I think, we kind of touched on gold a little bit earlier, but I think that's a kind of prime example because money's been flowing into gold as a safe haven asset, but that is very tied to the value of the US dollar. I mean, it's typically priced in dollars, and as the dollar weakens, it's kind of bullish for all commodities really, because it effectively makes it cheaper for anyone who's not paying in dollars as their base currency, but you're still having to kind of convert into dollars and then purchase the asset. So you've still got some exposure. And it's worth noting that if you look at the price in gold in sterling terms versus the price in dollars terms, that rally has been far less
it's more muted, isn't it?
Yeah. And I think we'll just go on to I've got a kind of just a mock-up here, illustration of how FX risk can really eat into your returns over time. So this is a fictitious company here called ABC Inc. And we've just assumed that you're a UK individual and you've purchased shares at $2 in January. And then at the time you purchased those shares, the cable rate is 1.2. And then over time, I've assumed it's gone up in a fairly straight line to almost 1.5. That's the orange line on the graph there. And then, so you can see that over time, over the course of that year, the share price in US dollars has doubled from $2 to $4. But so you've made 100% return in dollar terms. But because of that strengthening in cable, so it's basically gone up by 25% over the course of the year, that's wiped nearly a third off your GBP return. So that although you're up 100% in dollar terms, and that's those two sort of stacked bars, that the green one is your percentage return in dollars, the blue sort of turquoisey one is your return in sterling. So you can see here that effect, it's kind of completely decimated your returns really, hasn't it? And even if we look at that first bar where you can see that in February the share price has actually dipped by 10%. It's because sterling has just been constantly appreciating, it's making your losses worse and making your losses bigger and your profits smaller. So definitely something to be aware of if investing in foreign assets, that you've got that FX risk that can eat into your returns.
I think I get it. That's a really interesting slide. I think the other important thing to say there is all hedging is about trying to match your financial cash flows at the end of the day, isn't it? Which is what you're really highlighting here at the end of the day.
Yeah, and I think actually you've got quite an interesting case study, which we'll go on to in a minute. But I think I'll just probably useful at this stage to kind of highlight the kind of thinking process that we want, the kind of mindset that we want people to get into when they're kind of structuring a hedge or thinking about a hedge. And that's, okay, step one, identify your current position. Okay, step two, what's your size? Can you measure the size? Is it fixed? Is it variable? Think about the duration. Is it perpetual, or are you just hedging up to a specific point? And then, think about the instrument that you want to use for your hedging. Should you hedge in spot FX, or should you trade a forward? So I think we would always say, if you've got a long-term hedge, you should use the forward, because that's also pricing in interest rate expectations, which is something we haven't really touched upon, about the kind of dynamics of FX pricing. But I guess this kind of simplest way to think about an FX rate, which is always just the relative value of one currency against another, is it's effectively the kind of share price of a country, isn't it? It's a much better reflection of people's economic assumptions about that country than maybe the stock index, which probably consists of a lot of companies that have got a very international focus. I know I've always said that the kind of FTSE 100 is a very poor reflection of the UK, because you've got lots of internationally focused firms, lots of energy firms. They're all of the main firms are dollar earners, so they're not that exposed to the UK economy. Whereas the FX rate is really kind of pricing in expectations about interest rates, which in itself you can infer the kind of state of the economy by what the interest rate is doing. But it's also moving based on kind of relative demand for imports and exports. So if the currency is strengthening, you can kind of bet that the economy is doing well, because interest rates are rising, probably to try and kind of put the brakes on economic growth a little bit, and probably demand for your currency is going up because your exports are doing well. So that's something that's worth bearing in mind. And if you're just hedging in the spot market, you've got exposure to if assumptions about interest rates change, you've got exposure to that in the same way that you don't if you're trading the forward.
So really the difference there on your sort of third point, that duration piece, if you're going on holiday, you're going to make an exchange rate, you could do it now or then. It's when that payment date's actually due, but sometimes you don't always know that, right? So you might use a perpetual process. I think your last point here, beyond your execution piece, is really important. We should just say, this is all kind of wrapped in the game plan, is the policy, that what the company internally is comfortable taking a risk, as you were saying earlier, and has it got the money to fund that hedge should it go really negative against the market, which we'll come back to in a minute.
Exactly. So execute the plan and stick to the plan, but before you execute, make sure you're actually
sensible.
Make sure you're able to stick to it. So it's worth bearing in mind that as we always say, your hedge can go massively offside, but that shouldn't theoretically matter, because it should be a zero-sum game, right? Where whatever you're losing on your hedge, you're making on the other side. But as long as you can kind of account for that in your P&L, and also just make sure that you don't have some kind of liquidity mismatch where you're kind of having to fund the losses on the hedge in real time, but the revenue from the other side isn't going to be realized for a year's time. So it's worth it's always worth highlighting that. Make sure that you can afford to fund the losses on the hedge, and that's why I guess options are quite an attractive proposition, which is the kind of third type of product you might want to use. So you've got kind of spot FX, forward FX, but you could choose to buy an option, and you're probably not going to use that as a sort of direct hedge to kind of lock in the full value. You're probably using that to kind of as a defense mechanism against a kind of catastrophic move. So you're probably buying an option that's out the money, and then that kind of kicks in in the event of a significant move. But obviously the advantage of using a call option or a put option is you're just paying for that premium.
Your cost base is quite
your cost of hedging is defined.
Your cost base is very well defined.
Yeah. Okay. Which kind of brings us neatly on actually to the case study that you were alluding to, Julian, where their company didn't do that very well.
Absolutely. I mean, there's a whole raft of examples, Medical Cell Shaft, Enron, so on and so forth. But this one, South African Airways, back in 2003, really interesting one. Wasn't directly involved in this, just researched this for this show. And obviously it's particularly relevant because international, flag carrying airlines low-cost carriers in the past have on and off hedged different risks, including FX, including oil risk, right? So it's a really pertinent sort of example. And let's just think of the first couple of things here. They absolutely, in 2003, they had just committed to buy 41 Airbuses over a period of 10 years. And so they're going to be paying these off over 10 years. And they might have been renting them, but essentially giving themselves a large exposure to US dollar payments over 10 years. And of course, South African Airways are their sort of core currency, internationally flying, but their core currency is Rand, South African Rand or ZAR. So they've got this risk to dollar, and if the dollar was going to strengthen, this would effectively push their costs up dramatically for these 41 Airbuses that were due to be delivered.
It's worth highlighting as well that you know that the Rand is an emerging market currency, it is the volatility compared to something like cable or euro dollar is off the chart.
It is much more extreme, isn't it?
Yeah,
2, 3, 4-fold, right? Yeah, you're absolutely right, because actually those major currencies, the volatility tends to be relatively muted, right? 10% there or thereabouts, maybe varies, right? So actually, someone in South African Airways, don't know who, I guess someone in the Treasury team, read some bank research saying the dollar's going to strengthen. So they said, right, okay, let's put a hedge on for the 10 years. So as I understand it, wasn't there, don't know the full details. They went off and bought this dollar Rand hedge for 10 years forward. So firstly, that's a very long-term hedge, very, very long-term. Most budgeting for companies, PLCs, South African Airways wasn't a PLC then, is normally a year, maybe 2 years.
Yeah.
So 10-year hedge is a long time.
It's a hell of a long time, because even that's probably normally what you'd expect to be like an entire economic cycle. So if there's a downturn in that time, you might decide actually we don't want 41 new planes anymore, right?
Or simply the company may not be operating in 10 years' time, right? So the hedging it might be, it's a very long window. However, just in the context of buying those Airbuses, that's a 10-year. So, we are talking about actually an aligned hedge here, right? So important that the hedge, the process that hedge was going to do what it's meant to do, right? Effectively. Now, what actually happened, contrary to the bank research they read, actually the dollar weakened by 28%. Versus the Rand, as you were saying, right? So in 2023, literally within a few months of putting this hedge on, it had completely gone the other way. So this hedge is now deeply out of the money, creating a massive negative cash flow for them. Now, the hedge is theoretically operating well, but actually they've run past their credit lines and had a 6 billion Rand mark-to-market loss. Almost $1 billion. That's a lot of money for any airline, any company, right? It's a lot of money to have that impact and find that cash when I actually haven't got these airlines operating yet. These airplanes in my portfolio operating, generating cash, right? So we're really offside. So the key things there, if we just break that down, just really want to remind people, the hedge is actually a reasonable hedge. What appears not to have gone on is they've acted on impulse. On this bank research, the bank's going to be right. Let's hedge, and so that's a first big risk. And it appears, having read about this, that there was no internal risk analysis. If we do this hedge, what's the cash flow impact? What happens? What if the market goes down 50%, 60%, 100%? Those real disaster scenarios, unlikely to happen, but let's just plan that out. Could we afford it? So that didn't happen. It's a very long-term rigid instrument. So to your point earlier, no, there's no linear. This is completely linear. They completely fixed everything. They didn't do 10%, 20% layer in slowly. Which was sort of replicating an option or buy an option for that period, which would have been very expensive, of course.
True.
They wouldn't have wanted to have done it when they looked at it, I suspect. But they got this long-term rigid. I'm completely hedged in one go because the day's the day, which is often not the case.
And I think that's. I think that's a very good point, isn't it? If you're ever thinking that you need to execute a hedge with that much urgency, I think that sounds like kind of FOMO.
Stand back, stand back for a second.
But I think that's always great advice. If you're new to hedging, then just dip your toe into the water. You don't actually have to hedge the full size, in one fell swoop. Just
And most don't.
Exactly. You know,
Yeah.
we even talked about Ryanair, who've got a very well-established, very successful hedging policy.
Yes.
Even they're only doing sort of 80 to 70 to 90%,
They've
or
done
something
it all
like
in
that.
one day.
Yeah.
Exactly.
They
So
layer in.
dip your toe in. At least at least that's going to have some mitigating
Yes.
impact, and you can see the effect of it on your cash flow. See whether it's kind of fit for purpose, and then just constantly reevaluate. Okay, is this
Yes.
working? If yes, okay, well, maybe we're comfortable increasing the size. If not, maybe we need to, change our approach.
And I'm sure those companies are mark to marketing and saying, well, what if it goes down? Are my cash reserves enough to fund, beyond my credit line? If I go beyond my credit line, can I withstand a shock on my hedge to be able to pay for it? So what really appears here, and you at the bottom of your list, you had here that there was actually no defined hedging policy. And in my experience of 20, 25 years in this market, I am staggered how many companies I have worked with in the past that don't have a clear defined hedging policy. Really important. What is my internal business risk? What are my internal business limitations? Can I fund this hedge? And I've worked for companies where the CFO has called and said, whatever you guys are doing, stop, because we can't fund anymore. And that's not because we're outside of policy. It's just the left hand and right hand weren't necessarily linked, right? And people weren't monitoring things the way they should be. So it really is a real risk, a ubiquitous risk. So internal controls, is this hedge fit for purpose for my company's limitations? Really important.
Great. Well, yeah, a lot to unpack there, and I think we can probably
another
revisit that in future episodes for sure. But I think that's about all for this week. But thanks once again for joining us, and we look forward to speaking again soon for another episode of the Hedging Show.
Cool. Nice one.
Oh, thank you.
Thank you.
that's what I said. I really regret not trading Russia, because I would have pushed it and done unbelievably well. So it's kind of knowing what environment you're in, right? And again, in the slow markets as well, which we are now getting into for this year, next year, there'll be 3 to 4 months where it's going to be phenomenal. So in those 3 to 4 months, you need to be maximizing your risk.
Okay, so Omar, do it slightly differently to our other interviews. It's been a bit more about, you know, the company, what we're doing, trying to make it less formal and get a bit like more of an understanding of who you are and as a trader. So I guess this is for the industry. People in the industry definitely know you, right? You're very well known, but summarizing who Omar is as a trader.
So I think, who am I? The history of Onyx, Mandara, what we've done, what we've set up, we've kind of covered multiple times. In terms of my bread and butter day-to-day trading, I would say gasoline trader 90%, 10% naphtha trader. Very active, good relationships in the market, good relationships with traders, maintain good relationships with brokers. I'd like to say I've played a big part in building the volumes in the market, building the way the market is, the transparency, the efficiency, the regulation. So kind of treat myself a bit as a watchdog as well in the gasoline space, because it's very close and dear to me. And now, you know, if you look at the industry, a lot of the people who we kind of set this journey up with are now the desk heads in global companies on light ends. So again, it's a very passionate part for me. Of course, making money and, you know, trading the market well, maintaining market share is very important in terms of how I trade. But again, making sure everyone's kind of doing well and that the market is fairly regulated, is functioning efficiently.
So obviously we get defined, especially when we start at Mandara, as like curve strippers, whatever. Like, how would you actually define your trading? Would you just say I'm a trader, I do whatever trade makes money, or market making or arbitrage? Or
Yeah, I'd say my biggest trading attribute which I provide to the market is providing liquidity and good volume.
But how's that different? So, you know, before, I guess we were going to the market just trying to find our way and make money.
Yeah.
But now you see it more as like you are infrastructure, right?
Yeah, I think the markets have evolved and changed a lot as well. You know, back then it wasn't efficient. There was enough edge in the market to just, you know, collect premium and trade trades you like and make money trading it. So, you know, when we started the journey, I would say we were purely curve shavers, market makers, you know, taking, you know, positions you like, taking edge on positions you don't like, and kind of getting in and out. Whereas now you're kind of a facilitator. You need to be there on everything. You need to be there on good volume. So yeah, I would say you almost are constantly trading against the market flow. So you're trading against the market, giving them that position. So the main skill set in how I trade is how do you get into that position the market wants. So the evolution over the last 13, 14 years has been from, you know, running very clean positions, taking good edge, to now, you know, I would say in the industry, we run decent risk, we run decent position taking, which we can go into later on. So it's evolved a lot where, you know, that whole curve shaver, Onyx, you know, they're annoying, they're just showing bid offers, they're not there for size. That's completely changed. We are there for good volume. We are there to take things when it's moving against us and trying to get back into those positions. So our trading styles have evolved massively, which has benefited the entire market.
I think that is a good way of summarizing it. But I think that for you in particular, there hasn't been as much resistance to what you're providing to the market. Like if I was to think about crude or actually any other market really, we get more accused of, okay, well, if I trade with Onyx and I'm paying above value or selling below value, I'm losing out somehow.
Yeah.
But they seem to have in the gasoline market a more of an appreciation of the realities, which is it's very difficult, even if you get paid above fair value, for how close you're doing it to fair value and for the size. There's a lot of work to be getting out of that position or working into it or managing it. Because like you say, you're providing the liquidity, which effectively means you are warehousing the market's risk,
yeah,
which is very difficult to do. And I guess just leaning on that a bit more, why do you think there is a misconception, or why do you think there's not a misconception with you? You just think you've proved it over time that it's a difficult
Yeah,
job?
I think a lot of traders have tested me. I trade direct with quite a few traders for big volume. And again, what I've kind of made the gasoline market to be is almost as efficient and as liquid as a crude market. So, on a deferred crack, I'll be 5 cents wide, which is 2.5 cents from value for something in Q3
Next year.
for
Yeah.
about 500-600 kb, or 200 kb a month, which is kind of saying someone being 2 cents wide on a Q3 DFL.
Yeah.
And on gasoline you don't have that liquidity to buy 300-400 rubbers.
And the volatility.
The volatility, you have the crude spread exposure, you have the RBOB exposure, there's a lot of moving parts. So I think what we have done as a company is kind of, we've tightened the gasoline market to almost being as efficient as a crude market, which trades in 20, 30, maybe even more times volume than gasoline. So
But you think you've proven that it's clearly not you getting out for edge, and they're satisfied that that's the truth now?
yeah, I think the market knows a lot of how I trade is by warehousing big positions. As you've seen from my risk, at times you end up warehousing a couple of million barrels of rubbers, and that can be
And the rest.
and the rest, yeah, and that can be very
Yeah, it's difficult.
it works or it doesn't work. But again, we try and use all the edge we have, all the tools we have.
But that's what I was going to get to. So
Yeah.
when you're taking that role that you've kind of self-imposed, which is what we want at Onyx, right? We want to be that liquidity infrastructure. It's a genuine burden sometimes, but it's also what's embedded in that role is like you can't be there when you want. You have to always be there. That's what you're saying. So in order to do that, going back to what you originally said, there's all the classic trader know-how, the curve and all this kind of stuff. But actually you're saying your relationships in the market, you really need to know how everyone operates in order to do what you do, because otherwise you're going to get caught offside, right? So a lot of it is to avoid getting run over, if anything, rather than like making money out of them.
Yeah.
If you're going to provide that liquidity when they want it, you need to understand the whole picture.
And I think the traders also understand that it's a two-way thing, right? They know if they want to buy a lot of, deferred cracks or a lot of front cracks, and they lift me and keep lifting and keep moving the market higher and higher and higher, they know that it's not going to be a sustainable business for me going forward as well, right? So it's a two-way respect where...
You think they try and not run you over then?
Yeah, I think it's a two-way thing where they want their volume done at a price. At the same time, the same way I don't run them over, they respect our relationship not to run me over. And if they need to buy stuff, they might have to go to the market. There might be natural sellers who can do it better. So there's a two-way communication stream with the market on what the market wants. And again, the reason they come to us or come to me is they know if someone wants to buy 500 kb of cracks, I'm not going to go and lift the rubber 20 cents. I'm not going to go and lift all the cracks.
That's what I was going to say. So again, like trust is built out of experience and dealing with you, and that's, I guess, over time it's been proven that you don't do those things.
Correct.
But conversely, there are other market makers that do those things, right?
Yeah.
So I guess the good one to focus on is the market on close, right? The MOC. So that's a big thing in our market now, big liquidity. It's like TAS, it's like any kind of settlement contract, where the classic trader activity is to play around with the settlement. That's just like a very normal thing in most markets, and it's something that you've always refused to do, right? So if someone wants to sell whatever settlement is or buy whatever settlement is, it's a great liquidity time. If our competitors were to get hold of that liquidity, they're going to shove it in their face for unsettlement, but it's something you've never wanted to do.
Yeah, so again, as a firm, we probably didn't trade much MOC at all until 2 years ago. I think MOC started getting busier and busier and busier around 4 years ago, and a lot of people who had no influence or no edge in the gasoline space would kind of use that to build market share, to build, a way to make money. And the classic trade was, sell MOC and roof the window up, bid the window up. But again, with time, there's a lot of participants who want to trade the market fairly. And, this was kind of stopped a year and a half ago, where there's good liquidity in the E window. There's good people putting volume. So the whole being able to move it 40, 50 cents is not there anymore. So we do get active on MOC a bit more now, and that's purely, you can use that to get into good positions and get out of good positions.
You never went for the using MOC to screw the counterparts. What I'm getting at is like they always saw that
Yeah,
And that they were happy to trade MOC with you because they knew they wouldn't get screwed in the window.
correct, because you can see the name on the window and you can see what everyone is doing, and it's blatantly obvious who's messing around in this game. And I'm sure that will come back to bite people later on. But yeah, we'd never do that, and certain counterparties won't trade with those shavers or those participants that would clearly tell brokers, go and show this to Onyx or go and show this to a real counterparty. So again, I think our name has transformed over the years from shaver to not liking us to a high
Necessary infrastructure, right?
yeah, and we had an in-between phase where it was kind of shaver but not shaver, the love and hate. And I think we've kind of now transformed to the love side, where if anyone wants to, do anything big for volume, it's almost them reaching out to us. So it's quite nice where a trader will message me and say, okay, I want to buy 2 million barrels of this spread, or I want to sell 500 kb of this crack. And it kind of shows the trust the market has in us.
But it's also a philosophy, right? I mean, it's something like we're very different people, but clearly, if we take the big class of 2012 and Mandara that spawned all these market makers that now exist, that is the one area that we aligned, which was like we didn't feel comfortable with short-termism, right? So taking those trades where you can basically screw the market on settlement, or there's been times where someone misprices something so egregiously, you could literally make $1 million, but you're like, I'm just not going to do it. You've mispriced it. I'm going to give you the heads up, because it's just not orderly markets. I think that's unusual, and I think it's something that has to come naturally, because I think a lot of traders will say your job is just to make money, and you trade the market as you see it. And again, that's why people will forgive things like MOC. And let's be honest, right? It's not just the paper MOC; it's the physical MOC. There's lots of physical players out there who also do things that they shouldn't. And it's taking the view, or taking the philosophy, that you're a custodian of the market or an infrastructure in the market versus just there to make your money. So that is clearly the dichotomy, and you've obviously taken the former. But why? I mean, is that like something you are conscious of, do you think? Or
I think good principles, good trading, good philosophies will always come back to reward you, right? At the end of the day.
why do you believe that, though?
I think it's kind of proven how
Initially it
we've
was never
done.
proven, right?
Yeah, it's proven. Why did I do that initially? Again, maybe that's who we are. That's how we are as human beings. And you have a conscious. You make conscious decisions. And and again, you look at most market makers. They have no interaction with the market. They have no relationship with traders. They have no relationship. They're just people sitting behind a screen trying to maximize their P&L, which is fair.
It's one way of doing it.
It's one way of doing it.
But this is like the Trump thing, like the art of the deal.
Yeah.
Like clearly you have a philosophy that the art of a trade, and a trade can be anything in the world, right? There's lots of trades going on all the time, but trading very specifically in our market, you obviously take the view that the best scenario is win-win.
Yeah.
Or some form of win-win.
Yeah.
But I think if listeners out there, obviously in the industry, but then wider audiences, have a very cliched view that trading is all about you, and you've just got to make the money, and whatever you make is fair game. But that isn't the reality.
That isn't the case. And again, don't get me wrong, my mission is to maximize my P&L and try and use that information. But for me, it's more, what's the market doing? What's the market positioning? I get all that information by seeing what people I'm close to are doing. So I'll try and leverage that knowledge, what's happening in the physical market, what's happening. For me, having good relationships with traders and understanding what's moving the market can lead to making more money than, a short-term gain of, 3 days making decent money on MOC or pushing the market around. It's not sustainable. And you've seen a lot of people who built their business 4 years ago purely on just trading the window and MOC are slowly disappearing. They're slowly.
I think you nailed it in terms of it's a business rather than trading.
Correct. It is a business. It is a franchise. And, we are here. For us, starting from 2013, it's a 20-year project for us, for this business to be sustainable and do well, rather than, okay, let's maximize it for 2 years and then move on to the next thing. So again, it's principles, and it's what you believe in.
I guess it's a good time to ask, because in the hardest thing in business, I think, is succession, right? How do you, you've built your franchise and you've built it to a point where you've been able to get, to be honest with you, I think pretty mediocre people doing quite well because of what you've built. And I think they haven't always recognized that. People have taken advantage of that. I've made my feelings very clear on that with you. But I think also at the same time, you deserve a lot of credit because you have trained so many people to be so good. And if you look at the market making world in gasoline, there's probably at least 70% have worked under you.
I'd probably say pretty much everyone out there has kind of worked under
some
me
form, yeah.
or at Mandara or
Yeah.
at Onyx at
Yeah.
some point.
But how do you feel? I mean, that's the thing. I mean, really, we got close, right, with Tom Jackson in terms of taking over the franchise last year and being, then growing it in a sustainable way. But it doesn't work out all the time, right? What's your view?
Yeah, I think succession is incredibly hard because, when you're number one, there's nowhere higher to go, right? And we've had, over the last 12 years, I've probably had 10 waves of people pushing, it's intentional pushers where, they don't make money, they probably trade for scratch and they probably do the basic thing of, if someone wants to buy 100 kb of cracks, they'll lift the rub up 5 cents and then they'll offer it 5 cents higher and they'll make 6-7 cents on the trade, makes 5 grand, happy days, and do that 2-3 times a day, and they make money. Whereas for me, I'll try and trade around it. So again, people have pushed the market share push significantly over the last 10 years in waves. It comes and goes in waves. And for us, again, we kind of have our philosophy, we believe in what we are doing, and we kind of try and maintain what we are doing. But again, in terms of personnel, it's quite hard because, as you said, I would say we've had Jasper, who's been a core pillar of that desk for, about 7 years now, I'd say. So he's played a big part in kind of being that steady ship. And again, with him, slowly, this game of market making, you can't do it for more than 6, 7, 8 years. It's very knackering. If you're going to do the day-to-day grind, that's a 7-year lifespan. So Jasper's kind of at the end of that, and what we do with him next and what we do together and what he wants to do is going to be quite interesting because he has a wealth of knowledge where he can, he knows the naphtha market better than anyone. So the succession plan, every time with succession is there's always going to be an opportunity cost, right? For 2-3 months you have to sit back. So September I'm sitting back, and it's painful watching them trade. I just came after the window, and I was telling you earlier, these guys have a long way to go. So you will have periods of pain, you will have periods of where your market share drops, where brokers are unbelievably short-sighted. You know how brokers are, right? As soon as you start dropping a bit, they forget about all the loyalty, they forget what we've built for the last 12-13 years, and they moan and they complain. Because at the end of the day, when our market share drops and our volumes drop, the whole market volumes drop.
Yeah, they all start complaining.
And then they start complaining, trying to push us to do more because then they make more money. It's just very short-sighted nature. So again, it's having processes in place.
But I think you do that very, very well, and that's what I'm saying. You've proven, even with people quite mediocre, which has been proven because they've gone on and not done well outside of your franchise, they've done very well. And it's one of those classic things. You join a brand and a franchise, and what's frustrated me a lot is with your generosity and process and training. Even take like the LPG desk, right? You train another guy. Luke left us after a long time, did brilliantly well. He leaves. We train the next person, gets 6 months of training one-on-one with you.
Yeah.
And then he goes cheers and leaves to another firm. And you're going to get this. But I guess it's very frustrating for me when I see that there's no loyalty, or it's okay, forget the loyalty word because it's idealistic. It's more, can't recognize that they are doing well because of the training and within the system that they're in and the franchise you've built, rather than they start to believe basically it's them.
Yeah.
And I think that, being honest, I think it's something that you need to work on potentially. Or you could say the flip side, which is actually, if we look at the history and you say Jasper, and now we've got Tara, and you've got people like that who have actually quite interesting characteristics. Maybe the problem was we were trying to replace or replicate you, rather than saying, no, we've already built it. Now you need custodians, and you need a different type of mindset, more of a dutiful mindset.
And again, what Jasper and I have done really well over the last 2-3 years is we've pushed our tolerance for running risk and proprietary risk a lot more, because we've seen this market for 10 years. and we've seen the cycles, and we know when something looks cheap, when something looks expensive, and we get it right, 7 out of 10 times. There's, 3 times we get it very wrong, but the 7 out of 10 times kind of pays for it.
Yeah, but I think
so-
it's your proprietary trading when you say that. I think it's easy to fall back on the mindset of a fundamental trader, or a mindset of a proprietary trader in the oil market is you look at the fundamentals and you take a view. That's not what you're saying, right?
No, so
You-
for
you
us,
take- yeah.
it's more seeing what the market is doing, what the positioning is. Is it too heavy? Is the Y too high? Is it too low? Are people going to stop out here? And we have all this data on Flux and all our dashboards as well, which the market can access. So we try and see where the balances are in the market, what people are doing, what are we doing? Are we buying 2 million barrels of naphtha cracks every day in the front because of something else? If so, should we be long naphtha cracks in the front, or is the market too long and should we be selling into it? So we kind of use all these questions, and we are calculating 20, 30 things a second in our head. And as you said, we've also made the mistake where people not too experienced who sit next to us, as soon as we go away, try to emulate that without doing the 30, 40 calculations in their head, and without seeing 10 years of cycles,
experience.
right?
Yeah, exactly. We're talking about trader style, like development here.
Yeah.
And I think that what's interesting as you talk is like you have obviously iterated and become better and better as a trader, and expanded the risk profile. But in a way, it's like in line with the evolution of the market. It's been very in lockstep. Like the market when we first started was kind of stupid, right? Inefficient, all over the place. And the way it trades is kind of, you've evolved with it, which is quite interesting. And I think that's another thing. And this is what I wanted to talk about next, which is like, why do you think you are so dominant in this market? It's very unusual to be as dominant as you are. Like, I think now that we've had our strategy of starting Axis, which is another market maker within our brand, the idea was to maximize our market share and not cannibalize ourselves, right? Have like diversified thought and get market share that way. But gasoline and naphtha is so strong, it wasn't even necessary, because you're getting towards 50+% of the market share at any one time. And without trying to answer the question for you, the dominance seems to have come from that evolution. But how do you see it?
Why we are dominant?
Yeah.
Again, I've kind of answered that, but as I said earlier, we have, one of our main things is we have the appetite to warehouse positions, we have the appetite to warehouse risk, we have the appetite to take down flow, we have the appetite to generate good flow. Again, proactiveness, right? We, when there is things going on and when there's opportunity, we'll try and maximize it and trade every possible thing to generate positions that the market wants. So we're constantly trying to give the market what the market wants as well. When spreads look cheap, and I know everyone kind of wants to buy it, but they don't want to buy it, I'll try and generate quite a lot of that interest and just offer it to people who want to buy it, and then they will take it because they know it's a good trade and it's a good position. So
again, it's so in touch with the market.
In touch, being very, being very intense. And again, I've been trading quite actively from August to August, probably 13 months, having not traded for 18 months. And that whole intenseness wears you out. And now I've taken a break for about 10 days, and the body is now starting to hurt. Initially that adrenaline is still kind of there, and then it's the second week where you feel it. So domination.
But I think what we haven't said before, which you're saying, is actually this dedicated. When you get back in the seat, you know exactly what you're trying to achieve, which I know you're saying you want to maximize profit, and of course you are, but you are clearly, as a priority, it's not just market share for the sake of market share. You are trying to deliver a service to the market. It is almost like a broker, but a broker who takes risk. It's a much more evolved version of that, but it's in like that dedication to that craft. I don't think that's something that's really been properly said before. And I think that when you get up in the morning or when you get up to trade and you do your thing, it sounds like that is the very first thing that's on your mind.
Yeah. For me, the first thing is, what does the market want?
Well, that's unusual.
Right? What's my position? Is it what the market wants? If it's not, what's the market done? Do I quickly get out of that position? So there's a lot of things you think about, and every time I wake up, I'll have 10 messages from different traders saying, what are you looking at? What are you, and now they don't even they try and ask for two ways. They want to know what I want to do rather than what you want to do. And I'm
Yeah.
like, man, what do you want to do?
Yeah.
You're the
But
you're
now,
the physical
now I
trader.
realize sometimes, you do trade with the herd. And I realize now, as you say, it's actually very necessary because you're trading what they want to trade. The problem is when it reaches that saturation point, you can be a victim of the herd as well.
Yes.
Because you're trying to give them what they want, but that must be a very hard thing to gauge.
Yeah, it's
recessed.
very tricky. Again, the markets are very cyclical, right? Um, gasoline was had a pretty bad run from around 2015 to 2020, and then from COVID, towards the end of COVID onwards, it's been kind of a home run for most traders, where it's been very herdy. Russia, it just kept moving higher and higher and higher. So there was about 3-4, from 2021 to 2024, there was the best 3 years for gasoline traders because everyone was herdy, everyone was going with the herd. The market kept moving in that same direction. And now we're kind of back to tricky markets where it's a bit more range bound. It's a lot more choppier. So you kind of need to trade the range. You can't get too excited. And I would say it's only been the last 4 weeks where we've had some big momentum to the upside. It's been a bit choppy, but generally it's been a straight run to the upside in the East and West in gasoline. And again, I got caught out a couple of weeks back by, trying to fade that strength because again, the market was in a very range bound environment. And my view was the market's kind of getting too overexcited. And I got that wrong because there was a bit of Dangote issues, there was a bit of refinery issues in the US. But again, yeah, you want to be with the herd in the early move, but once it gets to saturated level or where it's starting to look a bit toppy or the OI is high, you probably want to exit at least half your position or half your length and then try and sell some and maybe even try and get short it because we're now in a market where there's a lot of supply of oil around. Refineries are going into turnaround, but again, we are not in that environment we were 2-3 years ago, right? I'm sure we'll get back to it in about 2-3 years, but as you've seen all the profits of the big trading firms, everyone's having everyone's kind of dropped 60-70% year on year for their first half results. So you're in a different environment.
Yeah, just back to that, like trading like the warehousing risk that the market wants. Another thing I think is like you, with your experience and with Jasper as well, you've got this sense of timing as well. And some of that is timing around noise, right? So knowing, and I think that's definitely a hallmark of a trader that really knows their market, is knowing when to say, look, come on, this is the market moving because of a bank holiday or because of whatever it is. And then you have the ability to wear that and for things to mean revert back to where they were or whatever else. And that's a big part of market making. The problem with that is that you can get increasingly confident about that and it can merge into a kind of directional trade. And we've seen this, haven't we, with like traders that we've trained or traders who we haven't trained who've traded with us, that can spiral, can't it? To something like you're warehousing it because you think it's noise, then it becomes a directional trade, then it becomes a loss trade. And it's that journey psychologically is difficult, right?
Yeah, it is. And we've been caught multiple times this year on the wrong move as well as the right move. So when you have the right move, it's perfect because you trade around it, you're trading really well. You're making money during the day, you're making money with your positions, you're making money on your prop. The key thing is when you muddle everything up with your your short-term position to your long-term position to your market making position, and it all reflects the same position, and the market is moving in the opposite direction, you're just fighting, and you're bleeding.
So you're not an emotional person in some respects. Like I wouldn't say you're not an emotionally volatile person, but I think you are, social and emotional intelligence, things like that. But there must be some emotional dialogue internally when these things are going on, right?
100%, yeah. It's very you again with experience and having a pretty good track record and generally being generally the P&L's pretty good. I would say our desk with the volatility in the last 7 years have probably had 3-4 losing months, but now with the more risk, the more VAR, the losses can be bigger, the gains can be bigger. So
what are you saying to yourself in these moments?
I guess what we've done quite a lot this year, myself, Jasper, even Tara, who's still quite early in her career, we the magnitude of the swings are a lot bigger, right? As you've seen. So, you come in, you're down a couple of hundred grand. It's easier to move on than when you come in and you're down a couple of million. So again, magnitude.
But can you think like what you literally thinking these days? I mean, do you go through?
Yeah, so I would say as the magnitude gets bigger, a big part of it is training your mind and body and everything to be comfortable handling more risk, right? Even the big traders at hedge funds didn't start.
So you're kind of like self-soothing thoughts, like you've seen this before. Like,
Yeah, so we've become more and more comfortable running the risk, but you're constantly, you're thinking to yourself, should I have cut this earlier? Am I right? I'm not sleeping well. Usually when you're losing money and you're sleeping well, I would say you have a good position on. When you're losing money and you're not sleeping well and constantly checking the market, your bias is saying, you have the wrong position off.
with us in Iran, that's how I felt.
Yeah.
And did you feel the same way?
Yeah, because we were short, a ton of flat price. And
well, there's lots of stuff we had on, and we had obviously a decently high conviction view on the way things were playing out. But
yeah,
I noticed that myself, and I think you noticed it yesterday. Like, yeah, it was constantly waking up all throughout the night to check what's going on. It's glued to your phone all throughout the weekend. So you would say that's a key thing, is it? Like,
yeah, but I would say with the whole Iran thing where we were quite short, flat price and spreads, even when the weekend attack happened, I think we were both pretty chilled about it. We knew, okay, this could be bad, but I think even if it's bad, the market will correct. This will happen. This will happen. We were our conviction was very high, and it played out exactly how we wanted it to play out. Right?
Yeah,
it happened quicker than we thought it would. We thought it'll happen throughout the week, but Monday evening, crude came off $10.
But what I thought was interesting was 12 years later since starting trading, it was probably one of the first times that, as you say, like when you sleep well, don't sleep well. After the fact, played out exactly as we expected it. Okay, great. But it kind of took it out of me. It must have taken it out of you as well, right? And that was a bit of a new feeling. Like we've had, last year we had a 70 million draw on one desk to peak to trough and having to be glued to that and figure it out. And there was so much pressure on us last year.
Yeah.
But it still felt like, our job, and it didn't really take it out of me. But this year it was different. Do you feel that?
Yeah.
Maybe that's just time, and that's just having done it so much. But
Yeah. No, I agree. It takes its toll. And again, then you question yourself, should I be running this kind of risk? Should we be more nimble? So I think we've gone through this year from running huge risk to running very minimal risk. And I think the huge risk has paid off
that's what I was
multiple
gonna say.
times.
We've had Sean back in helping us out. And Sean trained us both. He was, trading manager at Mandara.
Yeah.
Super risk averse guy.
Yeah.
And very methodical and process driven, which very much has its place. And I'm so grateful he was there to train us because we got that foundation first, and then we started to take more risks and experiment. And I think we always had a lack of that here. I'm so glad he's come in and brought it back in.
Yeah.
And he's there challenging us all the time, and you're doubting it. But the thing I would counter it with is, it's just not. We have never stood still. Right, and I don't think we ever will, or it's not who we are. And Onyx hasn't been able to build and grow, and your trading hasn't been able to evolve without you being able to take experiments and take risk. And obviously, that means that there's going to be times where you're doubting, and it's difficult. But at the same time, as long as you learn from it, then you're just going to get better and better. Right?
Yeah, I think the key thing is, sticking to the metrics we have in place as well. We have 3 or 4 metrics imposed by our risk committee, by Sean and team, by our clearing bank. And in a way, those are kind of self-fulfilling numbers, because every time we kind of go to the upper end of it, we either make a lot or lose a lot. So it's kind of trying to find that sweet spot where, how can you maximize your return with minimum risk, but the same way, when there is an opportunity, we have to try, or else.
I don't think we would have made money out of Iran 2 years ago, 3 years ago. I think if we had a 2022 situation now, we would make 5 times the money. Right?
Yeah.
I just think it's the evolution. That's what I'm trying to say. I think as long as, and that's I think something we learned from the Mandara days of proper self-review and self-critiquing after something has happened, good or bad.
Yeah.
That's the only way, right? You got to. I think that's what you're going through.
Yeah,
all the
and
time,
I
right?
think when you, again, key things are when you have a bad spell, reduce the risk, right? Cut your risk, stick to your drawdowns, cut the risk into half, cut the risk into quarter, because that just helps you
free up your
be
mind
involved in the
space.
game and reduce, free up your mind space, trade well, which is, which we do quite well. Maybe sometimes we need to do it quicker. And again, as you said earlier, is the learnings, right? What, we've pushed, we've probably doubled our, on light end especially, we've probably doubled our risk or maybe even tripled our risk at max points over the last 2 years, which kind of gives you a flavor into how extreme and volatile it could be.
But I also think
easy-
how we've evolved from grad traders to decent market makers to now being like a dominant part and driving markets,
Yeah.
right? You're able to take that risk because you are moving away from it's not just taking more risk, it's taking the driving seat of the market.
Yeah.
That is definitely become a newer thing, I think.
Correct. Yeah, leading the move,
Yeah,
being the
yeah.
move.
So
But
with-
again, it's
yeah.
with these things is learnings and separation, having processes in place. Because again, if you're more experienced, if it's me and you, or if it's more of a trader who has that experience, it's fine. We can have a bit of discretion. We can be a bit more lenient. But for the grads and the younger guys, having a person like Sean or having those processes in place is very important,
They need
right?
to be reminded that we've done all that.
Yeah.
They need to go through they're trying to act like you
Yeah.
way too early, but that's
Correct.
hard, right? They have
Yeah.
to. They see as a role model. They're trying to act like you, but
Yeah.
that's maybe something we need to get better at. But either way, learning, self-review, it always comes back to those things. But at the same time, do you think there's anything, or can you think of anything where you're like, no, I just have a regret about that? It's not really our natural inclination to have regrets, but
You have a regret. Some regrets in the market. I regret not trading the Russian years. Again, I had a bit of a drawdown recently. The market flow, the positioning, what everyone was doing was one directional. The flow was this way. The fundamentals was kind of supporting that, and I tried to, go against it, be a bit
that's
stubborn.
you can learn from that.
Yeah, you learn from that.
I think that's
So,
okay. I think regret is a hard one because it's like something that you didn't learn anything from. It's a hard question, and maybe there isn't an answer, but maybe the Russian years, as you say, like you wish you traded that. Is
yeah, I wish I was trading that. Again, regret, you always regret training people who leave, right?
Right, yeah.
You put time, you
But
put
again, it's a
effort, you
learning.
pay them a lot, and they then go and compete against you, or they're a threat to your business, and then you think, why do we hire these people? But again, we've kind of done the same thing as well, right? We are here.
But we left that is an interesting point because
Yeah.
when people say that, I'm like, well, the difference was these markets didn't exist in Mandara before
Correct.
we started. You
Yeah.
started gasoline, I started dated Brent, and they didn't exist. We built them, and then we trained people, and they didn't just live on. They made a lot of money when we left.
Correct.
So I think it's different because it's building, creating, and leaving. It was good succession.
Yeah, whereas now we are the franchise, right?
Yeah.
So yeah, I think the learnings, there's multiple learnings, from risk to how to optimize and maximize risk to minimize risk. Burnout, there's a lot of burnout involved. How do you make it sustainable? How do you make it, all our competition haven't been going at full steam for a long time, and they'll try it for a year and a half, and then fatigue comes in. There's so many things to manage, and
So do you think that long-term approach, because we said earlier, didn't we, it's not being short-termist. On the flip side, the advantage of being long-term, that has worked for your trading 100%, right?
correct, yeah,
Yeah.
and even now the succession plan is not an immediate fix. It's right. How do we fix it for the next 3-4 years, for the next cycle, without me and Jasper, and then the next 3-4 years? So we might take a hit in terms of our presence in the market, in terms of our activeness in the market, and my big clients, they might not speak to us. They're not, again, traders aren't short-sighted compared to brokers, I would say, but it's you have to rebuild it. There has to be a handover phase, and maybe it'll never be, I would say in every market there's 1 or 2 people who are exceptional, and I class myself in terms of gasoline market making, not being boasting, but I don't think there'll ever be a market maker who can take, myself,
dominance, yeah, control.
and Jasper in NAFTA, because what we've done is we've put our bodies on the line, our physical, mental, emotional stress,
But that's why it would be
families.
such a shame not to evolve that into a sustainable system, which is what you're saying. Which
So
is
we
what
are
you're
we
trying to
will
do.
evolve it into a sustainable
But I
system.
say you have in the past.
Yeah,
You've
and
just sometimes got unlucky with that.
correct, and we are, we are there, we are nearly there, and it'll be the next year. I'll be trading quite actively. I'll be training, handing over. I might do it for 3-4 years if I find a sustainable, if you can find a sustainable path for the whole team.
But your life, I would say that's a critical thing, I think, to talk about, because people
Yeah.
always say, what do you do to rest, recuperate, stay out of it? I think it's an easy one for you because you are always socializing, always finding joy in like random things, right? You do a lot of sport, you play a lot of sport, you watch a lot of sport. You're always trying to do the next event. I guess that's what keeps you nimble, right?
Yeah, so I think, finding things to do and being involved is very easy. But again, I think Jasper and I have very similar personalities. Sorry, not on the social side of things, but in trading, when we get into it, we just,
Yeah, you're
we are six. Again, you can then think, okay, why don't I just tone it down a bit, reduce the risk, still maintain market share and enjoy it a bit more. So I think that's the sustainability we're going to go to. But, I would say the last 14 months coming out of trading, back into trading with so much other stuff going on, personally and at work, I would probably say it's the most miserable 14 months I've had emotionally, because the strain of,
It's relentless.
because when I was trading COVID time, we were a company of 40 people or maybe 50. We didn't have a Dubai office, we didn't have a Singapore office, we didn't have, we weren't setting up a US office, we didn't have multiple different things going on, right? So you could focus on that. Whereas now, we've had conversations where you've told me, okay, you need to stop trading, I need help on so many other things, and it's hard. So the sustainable thing is going to come now, but those, again, the key thing, as we've discussed, is those 12 to 14 months. What are the learnings? So we've learned a lot. If you look at those 13 months from August till now, it's probably been one of our most profitable, 13, 14 months in a market where it's not being crazy, right?
Adjusted, yeah.
Adjusted wise, we've done very well.
Yeah.
We've, Tara's progress, we've hired Raghav, we have me and Jasper as mentors.
Yeah, we've got Sean now to help
We
with
have
the trade
Sean, so
development
we've
and
done
the
a lot
system,
of good things. So hopefully that strain is worth it, and I think it will be worth it. But again, yeah, there's so many things to be involved in that are more enjoyable, and the trading, yeah, it's how do you sustain it? How do you succession, and how do you do it?
What do you think your wife thinks
Of me?
of this, what you're saying?
So I would say, yeah, in the last 13, 14 months, she's seen a noticeable difference. I come back exhausted, I wake up at 5, check where the rubbers are, I check where Brent is. It's also that we've pushed it to the extent where we've run max risk, we've had max moves, P&L up and down. And, she's constantly like, why don't you step back? You've done this long enough, right? There are people to do it. But again, as I said, I always feel like I have a responsibility for the market. I feel like I have a responsibility to be there to provide that liquidity. Maybe it's a bit of ego, and you don't want to let
the
go
business
what
as well,
you've
right?
built.
You're doing what you're doing for the business as well.
So there's a lot to say there, and she's been very supportive, and it's been great. But again, just the fatigueness, not being present, mentally
I was going to
stressed.
say, the one thing I think about Angie, your wife, is that
Yeah.
she's very independent. And I think that without that independence, because she's not in the industry, it's very hard. I think she does have a very good understanding of it now, but growing
Yeah.
up, it's probably harder to understand until she did. But she kept that, you kept that good relationship, and she kept that supportiveness that you needed in the way it was given. Because she's so independent, she could go off and do her thing. I was happy with that.
Yeah.
I think about my wife, when she's in the industry, she's trading, we don't have to explain it, but I've had relationships before that, and it's very difficult. Like they just don't understand.
Yeah.
And it is very hard to understand unless you're in it, or unless if they're not independent and they're waiting for you to come home, or they're trying to live. They just don't want to see their partner going through this stuff. And like, not to put Jasper in it, he's don't want to get too personal with him, but he has obviously come to the end of that cycle and he's finding it hard and at times, right, to have so much stress and pressure on your central nervous system, like it's a physiological thing.
Yeah, it's a it affects you physically and mentally, your sleep, your stress, you're sitting in front of a screen. It's tough.
But I guess I'm answering that question, which we've already asked, I guess, which is, why'd you get up in the morning? But there is a duty that makes someone like yourself go above and beyond, right? If it was just for you, you probably would have stopped a long time ago, right?
Correct. Yeah.
Let's do a quick fire round. This is something that we're going to do on this series. So, don't think too much. Favorite trading book?
I'd say Market Wizards, because that's probably the first book I read. It's a bit of a boring book, but you learn the first one. I haven't read the second one.
But why did you read it?
It was just a good way to understand how traders think, what mentality, you had the old school Solomon Brothers traders, some big FX trade out of Japan. You just see how people, it was a good read into, emotions, tradecraft, into, how people trade fundamentally, how people trade technically, how some people do all kind of
There's
squeezes.
something you thought from that you think you could do it?
What's that?
Did you feel like once you read it, you feel like that's something I can do?
Correct.
And then what's your favorite book then, in general?
I think many people know I don't read. I probably read about 7, 8 books in my life.
But you like How to Win Friends, and
even that I read. I buy every time I go on holiday. I'll buy 2 books from W.H. Smith because it's like 50% off on the second book.
Yeah.
And I'll read the first 2 chapters. I was reading a book, how to not become friends with your phone or something, like how to lose, to stop using the phone. Alchemist was a very good book. I did English literature for A levels, so I had to for O levels. So Julius Caesar, but I'm not a big reader, unfortunately.
Yeah. Okay. What's your favorite film then?
Trading film or Titanic is a good one. One of the classics.
But why Titanic?
It's just an interesting story.
Okay. I think you're more of a music person, right?
Yeah.
So
Greatest Showman as well is a very good,
Showman,
it's very, it's not deep, these answers. In terms
Yeah,
of,
but it's an insight, right? So like you're not afraid to like the pop music and things like that. But why do you think that is? Because it's just like whatever, it's fun.
yeah, Lion King, we used to sing that every morning at Mandara. It just it's cheerful, it makes you happy. Again, movies like Departed, Inception, they're great movies as well. What was the other one? Good Will Hunting, Beautiful Mind. There's a lot more deeper ones, but
So what's the favorite event you've been to?
probably say the Houston Super Bowl.
Yeah.
Was my first experience into American entertainment, and they do it very differently. Differently to here.
Okay. So one word to describe your trading style.
Say, I move on, which is 2 words, but adaptable. So, a lot of brokers would say, you bought something at, at 10 and now you're selling it at 9 a second later. But for me, you just constantly move on to what's happening in the market and not get too stubborn to your position. So quick moving, I would say. I think that's probably one of my biggest skills, where I'll just, no matter what you trade, you remark the sheet, you price it in, and you kind of move on to the next trade.
So gunslinger.
Gunslinger, yeah, that's what came out when we did that thing at Mandara.
Yeah, I would say, but what you're saying is once it might take some time, whatever, to come to a conclusion, but once you have, the time between the decision and the action is very quick, right?
Yeah. I'll just move on, hit the next bid, lift the next offer. Yeah.
So a trading nickname, what would it be if you had to have one?
People call me the Don. You call
Do
me...
they actually?
Yeah, Don Omar.
Nice.
You referred to me as Messi at my wedding speech, so I'll take those.
So if you weren't a trader, then what would you be? And remember what you said in that Mandara thing
What
when
was
you were a
this?
kid, what you wanted to be.
I would have wanted to be a teacher. I don't know.
No, you said you wanted to be a bank robber.
Oh yeah, back when that was when I was a kid. But no, I would say teacher. I'd always, I had a passion of teaching. I
Did you really?
Yeah, I did that like in between my uni. Every time I used to go back, I used to do maths tuition.
Oh, right.
During A levels, I used to tutor people. Yeah,
You like that?
Yeah, building a school or kind of educating people is quite good. Running hospitality is quite good as well. A restaurant, a hotel. Yeah, so I would say education and being kind of in a hospitality.
It's definitely more people stuff.
Yeah,
Okay, so do you have a favorite trading quote?
I would say off trading. That's what I use a lot. So I'm quoting
That's your
myself.
quote, yeah. Fair
Which
enough.
is being, there's a lot of things I say that's
But what
quoted
about
in
like
the market.
risk management type quotes?
Again, don't read much.
Cut your winners? Cut your losers,
Cut
sorry.
your winners.
your
Yeah, I would say Gartman had
Or
some
move on,
very,
like you say.
Gartman had, I think Gartman's, was it 10 or 11 rules was quite good, and it was kind of a Bible we used to all use. But yeah, I would say, yeah, mitigating losses, cutting your losses is probably, and another one is, no one kind of blames you for taking profit too early as well. So sometimes taking profit is good. You shouldn't cut your winners too early, but, in choppy markets, taking profit is quite good as well.
So what's the final question then? What's one skill you think every trader should master? Let's say in this market.
In this market, as in this environment, or in oil, or
Why don't we say one in oil, one in general?
in oil, probably, I'd say it's very cyclical, and every event has kind of happened 5-6 times in different magnitudes.
So know your history kind of thing.
So kind of not be short-sighted. There's a lot of people, the average age of our grads must be like 25, 26, and they've only seen 3-4 stellar years. So I think in oil, things go into cycles. So managing expectations, managing targets, not over stressing, not over pushing. I was with a trader yesterday playing golf. No, I can't remember who said that. But they mentioned, you should be running. He mentioned that trading houses have probably made 20-30% what they made last year. But the same way he mentioned trading houses should be running 20-30% risk they were running last year as well. So kind of adapting to the environment, right? So every time I have chats with the NGL desks, I say, guys, you all should be maximizing position, market share, risk when things are good. So that's what I said. I really regret not trading Russia, because I would have pushed it and done unbelievably well. So it's kind of knowing what environment you're in, right? And again, in the slow markets as well, which we are now getting into for this year, next year, there'll be 3 to 4 months where it's going to be phenomenal. So in those 3 to 4 months, you need to be maximizing your risk, right? So yeah, I think in oil, knowing what regime and what wave of the cycle is quite important.
But to be fair, that's a good trading one in general as well, no?
Yeah, and in other markets, again, I'm more of a long-term investor. I've invested in a lot of funds, but again, I regret not being a bit more active. I've held crypto now for the last 3-4 years. No, probably the last 7-8 years for decent volume. But I've just watched it go up, down, up, down, up, down, and luckily it's up at the moment. But again, there's ways.
There has to be a time to take profit type thing.
To take profit, re-enter, optimize, move things around. But again, we've put a lot of blood, sweat, and tears, and time and capital into Onyx. So I think we're both just too.
Can't do that all the time.
Yeah, we're both too focused on that, and now we have Lige running an Onyx internal fund. We should probably get him to run like a personal, like hedge fund for all of us as well.
Yeah, with our own money.
With our own money, which could be good.
That was great, man. I think that's an opportunity to like reflect after all these years. What's it been? 12 years trading, and yeah, I don't think we've done that before, and I hope that was useful for you as well.
Yeah, I think it's the first time we kind of got into the emotional
Your
side of things. Cool.
All right, thank you,
Thank you.
Emma.
Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning Development here at Flux Institute.
I'm James Todd, Trader Performance Manager here at Onyx Commodities.
And I'm Will Cunliffe, a Research Analyst here at Flux.
Plenty of charts, risks and trends to discuss this week. Firstly, news out over the weekend, again, that Donald Trump is pledging $2,000 stimulus to over 85% of the population. That's certainly supporting gold and equities this morning. We're also close to the end of the government shutdown. It looks like the end of that is nearing. US layoffs are surging. There's bad economic data, and also University of Michigan consumer confidence in the United States is now the second lowest levels ever. Looking at equities, we'll discuss the fact that earnings are growing at the fastest pace in 4 years. That will support, of course, equities. At the same time, last week, Michael Burry started to go aggressively short of particularly Palantir and Nvidia. So we're seeing much more volatility and a more aggressive sell-off last week in the AI stocks. So let's start with the news of Donald Trump announcing a tariff dividend up to $2,000 for up to 85% of Americans. Again, this is going to be inflationary. It's going to be more of a debt burden. It will put the Federal Reserve into more of a quandary. Inflation versus should they be cutting rates? This morning, gold is up 2%. Equities, the Nasdaq's up 1.2%. Yields are up 5 basis points and the dollar is down. As Paul Tudor Jones has said, all roads lead to inflation. And you can see the gold chart here. That's a clear fall from the peak. It's gone sideways and it's ticking up.
Yeah, it's an interesting idea. My question is obviously going to be, what will the pass-through of this $2,000, if it were actually to be enacted and handed out to 85% of the population, what would the pass-through of that be on, US produced manufactured goods, the sort of key areas that Trump is trying to target with the tariffs overall? Ultimately, if you're seeing demand substitution from cheaper imports to more expensive domestic supply, having a $2,000 windfall is probably going to be, in theory, in a purely economic scenario, quite good for that domestic demand. But in reality, I think a lot of people might look at that and think, well, equities keep going up. Maybe I can pass, my $2,000 just into a one-time purchase in, the S&P ETFs and that sort of thing. I think it's no surprise to my mind that we have seen equities up and gold up off the back of that, rather than because of an underlying belief in the US economy. Do you see equities going up more? Well, there are going to be more buyers than sellers for a little bit. And yeah, it's going to be interesting to see whether this $2,000 tariff dividend does actually happen. I was looking at Polymarket this morning, and yeah, over the weekend, the odds of a 2025 tariff dividend jumped from about a 5-6% chance to over 20% chance. It's still quite volatile, but yeah, I don't think there's a clear conclusion that Trump definitely will do this, especially within 2025. So it might be a case of buying the headline rather than buying the actual truth.
Yeah, for sure. I mean, I would probably second that I think it's going to be pretty challenging for him to actually implement it. He says that it will be funded by tariffs. If you look at kind of data from the Treasury, tariffs have yielded about $195 billion worth of tax revenue during the fiscal year 2025. About $30 billion a month now at the kind of the higher tariff levels. But this package would cost in the region of $600 billion. So that's a pretty big shortfall that's going to have to be funded through issuance. And, part of the reason we are in this US government shutdown is because fiscal strategy is not something that the government is able to productively debate. And both sides of the discourse are still remaining gridlock. It looks like they might be able to sort stuff out, but it's still tenuous, and there's still a lot to be worked out on the kind of fiscal side.
And call me a cynic, but last week Donald Trump did particularly badly in the elections, and his ratings are falling. So clearly this is trying to support his ratings somewhat.
Yeah.
And the other point is, it's another example of how he's making it extremely difficult to trade markets because he comes out with these either just Twitter headlines or just false promises.
Yeah, definitely. And I mean, to me, it screams, COVID stimulus, just kind of throw money at a problem. And funnily enough, 2 years down the road, you've got pretty persistent non-transitory inflation that the Fed is going to have to deal with.
And one thing clearly is the winner is gold again. The gold trade is back on, as we can see from the chart. You can see it's clearly breaking higher again. Clear levels to have a stop loss as well, just below 4,000. Again, the market will be jumping on that trade, especially the shorts that were getting extremely nervous by the sell-off. If we move on to US layoffs, the Challenger Gray announcements last week. US-based employees announced 153,000 job cuts in October, the highest for any October since 2003, even including financial crisis and COVID. And there's been over 1 million layoffs announced to date. So although we don't have the official government data coming out for payrolls, you can see that there's clearly weakness in the market. Clearly the Fed will be focusing on this. But again, if there's going to be a stimulus package, that just throws more, what's the word? What do the Fed do? You've got inflation on one side, weaker data on the other. More unknowns, and Donald Trump trying to get them to cut aggressively.
Yeah, and I mean, if we look at recent history, Powell's response to that kind of tension in the dual mandate has been to wait and see. So, I mean, I think the market is looking for the Fed to cut. I think at the moment they're pricing as if they want the Fed to cut. And I think this will obviously fuel the fire. I think the market's also having to adapt with the lack of national data, with the lack of data from the BLS. We don't have payrolls that we can look at. Perhaps that's a good thing, given the amount of revisions there have been in recent years.
It's woefully inaccurate.
Yeah. That's been a long time criticism of the likes of the ADPs or Challengers, is that they vary massively from the payrolls. But if payrolls are constantly revised, then maybe it's a good thing that the market's shifting its focus. But it's concerning for sure as to where that puts the path of the Fed funds rate. I wouldn't be surprised if we're holding a little bit longer.
Also, if unemployment is going to creep up, this is bad news for Treasury Secretary Bessent, because they're trying to inflate and grow their way out of debt, and clearly this is all bad news.
It's also, I mean, it's why I think it's always good to have multiple sources of data to help you get an accurate picture of how things are. Because I saw another chart similarly saying, job openings are at all-time lows. And whilst job openings at all-time lows, you can sort of think, okay, well, that's not necessarily going to be bullish. To some extent, you can see job openings drop when capacity is full and people are, going at full berth. Whereas with this, you can see that job openings are low and sackings are high. So you've got a clear, you've got A plus B equaling C here. You've got low job openings, you've got high sackings, so you are going to see unemployment pass through. It's not a question of if one, the other. The two combining makes it quite clear what's going on.
And one thing I don't see governments discussing is the impact of AI on jobs. I mean, Bernie Sanders came out and he talked about 100 million job losses over the next 10 years is pretty extreme one way.
Yeah.
But AI will have an impact on jobs for sure.
Definitely. I think that's going to be most pronounced in the likes of the Indian economy. So if you look at service sectors broadly in the West, they've already kind of extradited a lot of those more manual, menial jobs to India and places like that. Now, those are the first jobs I think that are going to be hit by AI. So yeah, if I was India, I'd be looking at that pretty closely.
Yep. If we move on now to US consumer sentiment, it fell to 50.3 in October. You can see from the chart here, that's the second lowest reading ever. Now, Donald Trump, not to pick on him, but he says it's a great economy, and equities are at high levels, which is good for equity holders. That's normally a sign of confidence, but clearly confidence is low here. More bad news for the economy, more bad news for Donald Trump. And the Fed have to look at this.
Yeah, I'm not surprised that consumer confidence is low. Especially considering how chronically online a lot of the US population are, etc. Like, I spend my time on Twitter and X or whatever, and I just see bad headline after bad headline after bad headline. So of course that will get passed through. And as you're seeing more and more unemployment, less security over people's jobs in the future, it's not surprising to me at all that we're seeing consumer confidence falling off a cliff.
A good point on what you say there. Do you think actually social media polarizes views even more? So that's why we have a worse reading now?
Yeah, I'm certain that it does. There are a lot of things that, like we talk about equities, the fundamental landscape of the equities market has changed over the past 30 years because the ease and accessibility of retail to go and sort of buy means that historic facts and figures, whilst they hold some non-zero value, they're not necessarily the best forecaster of future equity prices. Similarly, in terms of public opinion, even if you look back at the 2016 Cambridge Analytica stuff, in a US election, you saw something that had never been done before because of the social media craze. Yep. I think it would be naive to think that hasn't, been exacerbated and continued further over the previous 9 years. So we live in a world where social media really does dictate a lot of people's moods and opinions on a day-to-day basis.
Definitely. And I think, a lot of people are attributing the kind of rally in broader US equities to kind of flow story, right? So retail will just buy and hold. Instead of savings going into sort of, in the UK, we have a cash ISA, people are putting it in their stocks and shares ISA or their 401k, they're allocating to equities. Now that was true during COVID, they did hold, but consumer sentiment, as you can see, was quite a lot higher there. So I wonder if kind of we're reaching those levels now where maybe retail will start to pull out of equities, and that flow might reverse. And as we've discussed before, that's a pretty leveraged position, which if it unwinds could be pretty aggressive.
And that would push consumer confidence lower,
exactly,
along with job losses going.
Yeah, and it becomes a kind of snowball effect, almost self-fulfilling.
Okay, let's move on to equities. As we say, I've been fairly bearish talking about equities, and the fact that we looked at retail traders have been adding over the last few months, hedge funds have been going short. But US earnings are growing at the fastest pace in 4 years. That will definitely support stocks. Here you can see data from the FT. But if we go on to the next chart, you can see the NASDAQ here. So the NASDAQ, that would be typically seen, that's a rising wedge pattern. Typically when it breaks, you'd start to get an aggressive sell-off. Short-term moving averages started to roll over, but on Friday we did get a bounce, and we're going to get a bounce today. It's already up 1.2% over this potential added stimulus. But why is to my view, that means what we're seeing more volatility, and again, Michael Burry selling, looking at buying puts, so going short of the big AI stocks. To me, this would see a rotation out of the AI and the tech back into the more Russell 2000 and the S&P stocks. If we go on to AI data center borrowings exploded in September, raising debt and power concerns. Sam Altman came out last week saying he wanted the US government to backstop there over $1 trillion of potential investment, which I don't think the taxpayers can be too excited about. And over the weekend, the CEO of Microsoft says they have thousands of GPUs that are sitting idle because they simply haven't got the power to run them.
Yeah, I mean, Microsoft, I think in one of their, maybe an internal memo that was circulated about data centers, said that, looking at 2028, 2029, it is going to be impossible to overinvest in these data centers, indicating how fundamental they see these data centers in being, to their future business and I suppose the future of the AI world. It seems absolutely crazy. I think I don't see it as sustainable, but I also am not an expert in the field. I mean, it's as pure and simple as that. It's entirely different, and the sheer strain on like a national grid that data centers will be by 2030. You're looking at OpenAI projected to have more power demand than the UK by 2030, which doesn't seem sustainable to me.
And you're already seeing in states with data centers the cost of electricity going up, which is going to be inflationary. But surely now the smart money is to move out of AI and into power generation stocks.
Yeah, I mean, I suppose it's derived demand in that sense. But if you do have, a fundamental buyer perennially, then you're going to be well to be operating in that space.
If we move on, we mentioned Michael Burry, famous for his role in The Big Short. He's actually always looking to short markets. He typically goes in too early, but he announced last week he's gone aggressively into shorting with puts, particularly Palantir and Nvidia. Apparently he's put 80% of his worth of his fund, $1.4 billion, into this. Again, it's not that much risk he's risking because he's in there via options. But we've seen Microsoft fall nearly 11% in the last 8 days, Nvidia fall 12% in 4 days, Palantir falling 16% in 4 days, and Meta falling nearly 19% in 7 days. So these stocks that have had all the huge flows, these big AI stocks, the Magnificent Seven, are now certainly seeing some volatility and struggling.
Yeah, the classic quip about Michael Burry is he's successfully called 17 of the past two recessions. Yes. So, he's a perma bear. And to some extent, the market doesn't always adhere to his positions and go the same way as him. But one of the things to note, especially in the past week, is he does, a trick that I suppose Musk has done a few times. And if you look at the US senators, they seem to always pull this rabbit out of the hat. He goes on Twitter or he goes on X and he mentioned something about a bubble just after having put on a massive short position. And a lot of speculators look at that and they look at what he's saying. And so they either take length off or they actively get short. So it becomes a bit of a self-fulfilling prophecy. I think ultimately a lot of the softening in these Mag 7 companies, part of it will just be a knee-jerk reaction to that. So it wouldn't necessarily signal a wider realization in the sort of trading zeitgeist that everything's a bubble and it's overdone. But these are the sort of cracks that do appear every now and then. And yeah, ultimately, because everything is so overextended in equities, when this goes, it will go really fast. And the fact that we've seen, Palantir off 16% in 4 days, that's a sign that we are. I suspect that this will go, and yeah, it will be very sudden when it does.
And there's a huge amount of leverage and there's a huge amount of retail, and that would hit consumer confidence even more, which hits retail spending.
Yep.
It's a knock-on effect. If we actually look at the chart here, Palantir against other S&P stocks, you can see it's recently traded over 240 times forward earnings. You can see where it stands out, forward price to sales ratio and forward price to earnings. It's a clear standout here. Highest valuation for a company of its size, 491 billion in history. If we move on to the next chart, you can see the actual chart of Palantir. Actually, it's had a sell-off, but you can see where it's come from. It looks to me like the trend is still upwards. Support, you can see the white line. To me, I would say that's the first real line of support, $173. It's holding above that. The next level of support will be $147. To me, that's still an uptrend for now.
Don't disagree. Yeah, I mean, it is, ultimately quite a volatile stock as well, which will mean that if you're looking at having scale in, similar to what we're going to be talking about with Bitcoin here, but if you're someone that missed, 147 before, you're probably going to be putting a buy order in at 147. And similarly, scale back buying at like 120, yada, yada, yada. So you will see scale in buying at these sort of key sticky levels. And as a result, yeah, it will face resistance when going down.
Support. I would say also,
as in when the equity is coming off, it's going to face resistance there. So it will sort of bounce off these sticky lower levels.
I would also say below those key levels, you would see some stop losses as well.
Yep.
But I agree, right now it seems to be still an uptrend. Moving on, commercial mortgage-backed security delinquency rate jumps to 11.7%, the highest level in history. It seems to be saying I'm talking about just bad news here. I mean, where's the good news? Where is the good news?
Arsenal top of the Premier League.
Okay.
This chart is clearly quite concerning. I think people have been concerned about commercial real estate for a while now, so this is not going to be coming as good news. I I do think there's an element here that obviously we've been in a kind of higher for longer scenario at the Fed, which has been elevating mortgage rates, and an element of that will kind of increase delinquency. But hopefully we're going to get a cut in December, which should alleviate some concerns. There's also been tightness in broader liquidity markets, so in overnight repos have been drawn on a lot. So that should be alleviated.
Having said that, the cut's 16 basis points price, so it's nearly 50-50. So we have, I think, 9 Fed speakers speaking this week. They haven't got much data to go on, so it'll be interesting to see how that plays out, if the Fed try and steer that.
Yeah.
But fair point, commercial mortgage-backed securities don't have a big impact on the wider economy. Does that have an impact on the banks, though? The banks have a lot invested here. So maybe the warning signal will be if bank stocks start to fall, particularly regional banks, where we've seen some stresses already.
Yeah.
Moving on to bonds and interest rates. We just started to discuss it there. This is the US 2-year yield. You can see clearly the lows from COVID. You can see here we have a clear support now at 3.4%. I kept saying I'm expecting this to go lower because of the economic data is appearing weaker, the data we're getting, the layoffs, unemployment going up. But now, if there's going to be more stimulus, you might see the market start to look towards two things. Firstly, inflation, so the Fed are less likely to cut. Secondly, people saying, well, we don't want to be holding bonds if debt's become an issue. They would more move down to the far end of the curve, but yields across the curve are up 5 basis points today. To me, if I had to put a trade on here, I'd sit on my hands and do nothing and wait to see which way it breaks.
I think that's, ultimately a good decision here, because especially at the moment when everything is hypothetical, talking about stimulus, we've seen Trump, chickening out time after time on these things. He will tweet something and then he'll renege on it. So this idea of, well, it might break to the upside if we see stimulus and inflation and see the Fed less likely to cut as a result. We're sort of like dealing in 4 separate orders of conditionals. Yep. So I think you just got to wait and see. And if you're making, if you're putting a trade on, if you were buying this for that logic, you should only be doing that if you have an edge that the rest of the market doesn't sort of really value correctly, i.e. you are certain that there is going to be inflation coming from this stimulus and you have an advantage over the market in that sense. Being in a position like mine, and I assume yours, where we are just sort of observing and aren't particularly close friends with Donald J. Trump, just sit and watch. And
I wish I had some inside information. Unfortunately, we're not that close yet.
No,
not yet.
A trade I do like on that, looking at yields, the US 2s 10s curve. You can see the next chart here. You can see we had the big sell-off. The market was in negative. The 2s 10s was inverted for a long time. We had a double bottom. It's rallied. We're currently at 53 basis points. It's gone sideways range for a long time now. What's that? Nearly over 6 months. The range we're in, the upper range there is 61 basis points. The lower range is, 64 and 41. So this is the curve steepness, the 10-year minus the 2-year. If we start to see more concerns about US debt, and 6 months ago, that was the big story. Yeah. It's gone off, it's gone secondary with weaker data and gold. Mm-hmm. If that comes back, then I expect the curve to steepen because it will be the long end that people don't want to hold.
Definitely. I mean, that's what we saw. That's what we saw last time. Even though the Treasury had front-loaded a lot of the issuance, we still saw that kind of shift of liquidity down to the front of the curve. I think there's going to be a couple of things that would also aid that. If we perceive the Fed to be a little bit softer on inflation, not quite so focused on that 2% target, because at the moment inflation's around 3% and they seem to be happy to cut. If they're perceived to be a little bit softer, then we could see break-evens rally at the back as well. And then if Trump is expected to be more loose fiscally, then that could also boost growth expectations down the back of the curve. But yeah, it seems like we're stuck in a range for now. I had expected this to go steeper earlier, but it seems to be pretty stuck.
Yeah, the other point, there's a long end, but also the front of the curve. Do the Fed, do they or don't they in December? Yeah. Say it's 16 basis points priced. The market's, 50-50.
Yeah.
Pretty much. Moving on to the UK 2-year yield, you can see there's a similar support line coming there at 375. And we don't have any stimulus coming out of the UK. I very much doubt the budget Rachel Reeves will be giving a £2,000 stimulus to everybody. I can hope, but it's not going to happen. We're going to get tax hikes instead. And pay-as-you-go driving charges for electric vehicle drivers and all sorts of others, perhaps even a mansion house tax.
Changes to national insurance, changes to ISA contributions. Yeah, I think a lot of people, it's hard to know exactly what she does. Sometimes almost Trojan horse a softer landing by, the last major budget. It was softer than people had.
There was rumours of huge capital gains tax hikes, and then it came out a little bit softer. Yeah.
Clearly here, they're giving out all the potentials, all the possible bad news. So when we get it, it won't be as bad.
Yeah.
It's not going to be good, though.
I would think it unlikely.
And let's move on to Brent.
Yeah, I mean, you want to take us?
Yeah, so I mean, we've been kind of consolidating, drifting towards that kind of $60 handle over the past week or so.
Sorry to interrupt you. This is just say a long-term chart here. This is a 5-year chart.
Yeah, and I think there's a lot kind of driving flat price Brent price action. We've had obviously sanctions drive concerns of like trade rerouting, especially regarding India. Are they going to keep lifting Russian barrels, or are they going to have to go to PG to kind of rotate their feedstock? There's a little bit of a scramble, but that seemed to have been dissipated. We saw them offering PG grades back again. So that it doesn't seem like the market's scrambling for barrels right now, especially on the time spreads. We've seen them soften dramatically. So front spread in Brent is now at like 20 cents. And I think the market still seems concerned about oversupply, and everyone still seems concerned about these bearish balances. But then at the same time, we've got like refinery margins are at yearly highs, especially in Asia and Europe. We've got really strong margins. We've had a bit of refinery outage kind of across Europe and Asia. Dangote's RFCC is down and their CDU is down. That won't surprise many people, but that's been constructive in the product cracks. We are yet to see refinery utilization tick up off the back of that, but that should pass through with time. I mean, there's a lot of spare capacity, especially in China. I think Shandong are running at about 55% utilization.
But a lot of refineries are in maintenance as well at the moment, aren't they? So that's a typical seasonal pattern you see where they go offline for this part of the year. And so if a refinery is not purchasing crude, you see less sort of upward support.
Exactly.
To my mind, the major story in crude is just still about, like, yes, oversupplied to the downside, but that headline last week about the sanctions on Russian barrels, and particularly the sort of parties purchasing from Litasco, Lukoil, sorry.
Rosneft,
Yeah, what amazes me looking at this chart, away from the fundamentals, is just we've been in such a narrow range for 3 years now. We've seen gold surging, we've seen other commodities, copper surging, but this has gone sideways. Tough one to trade. And we had a few of the big trading companies talking about next year's prices, and they're all anticipating it in the 50s, aren't they?
Yeah, I mean, I think the consensus is pretty bearish. I think a lot of that is to do with the kind of anticipation of unwind from OPEC. But I mean, if we look at the most recent set of OSPs, official selling prices from Saudi Aramco, they were pretty firm. Like, market structures had implied a cut of about $1.60 for Arab light into Asia. Instead, we got $1.20. So that's kind of indicative, at least in my mind, that there is still firm demand from Asia. They can still charge a little bit more than structures imply. And that also suggests that they're not just going to release the taps and start pumping more. Because typically, if they were to do that, they'd need to make space in the market by offering a slightly cheaper price. So yeah, it's a confusing one at the moment, I think, for a lot of participants, but yeah.
I like the fact when I mentioned predictions, Toddy, you pull a face. The value of predictions is close to zero, isn't it? Because we have all these predictions where S&P will be at year end. They mean absolutely nothing. I don't even know I'm having dinner tonight, let alone predicting the future. The only thing that matters at the end of the day is the price. Moving on to currencies, the dollar index, you can see here it's stalled at key level. It looked like the dollar was getting stronger. It was. There was a clear double bottom around 96 level. We can use with a more potential stimulus coming out. And if we look at that on the next chart, the dollar yen, here you can see a clear trend line support, clear resistance. We're up at the top end of resistance. In theory, this should go down if the Fed are cutting, the Bank of Japan are raising rates. But now again, it looks like it's a straight dollar trade. Is it going to go up on inflation or weaker on US data? But clearly, again, a good one to trade. Trend lines like this, there will be stops just above the upper resistance. There will be stops just below support. And to be honest, I'd wait and trade the break. And the last currency, the pound, you can see on the next chart, the pound sold off pretty aggressively the last few weeks. It's broken key support levels. It's come back to retest it. To me, it'll be interesting to see if the short-term trend, the downtrend, continues from here. You can see where the clear resistance is, but the pound's looking weaker than the dollar.
Yeah, and you know, I'm not sure, as and when Rachel Reeves comes out with her budget, I'm not sure we're going to be seeing the pound strengthening at all much there. I, wouldn't be surprised if we see that downward trajectory.
Although that being said, I think a lot of the kind of the talk about fiscal restraint and hiking taxes has driven flight to gilts, and gilts have benefited quite a lot from all of this rhetoric. And if we see a kind of a pair back in their pro-tax agenda, we may see a bit of selling in the gilts, which could aid the pound on an interest rate differential basis.
Yep, interesting. Onto Bitcoin. Bitcoin, you can see it's bounced off key support there, right on $100,000. Round numbers tend to be key good support and resistance levels. But it looks to me it's been going sideways literally for the last year, a small up bias. But again, if this closes below 100,000, then that would be pretty bearish, I'd say. Any view here?
Yeah, I mean, I think my point earlier in the show just about people scaling in order to reduce volatility. If you're on one of your dealing apps, you will most likely be given the opportunity to, purchase at a level as and when it hits it. So you will just see stickiness around these $100,000 or these sort of quite nice psychological levels. And I think Bitcoin, much like FX, you see so many things on YouTube saying, "Oh, learn how to trade with me," and people pay a lot of attention to key levels and also to the nature of charts ultimately in both FX and crypto. So yeah, I wouldn't be surprised if you do see proper support here.
One chart I didn't put in, actually, I meant to. The correlation between the Nasdaq and the Bitcoin for the last year and a half has been really close. It's broken down though in the last couple of months with Nasdaq going higher, Bitcoin breaking lower. That would concern me actually if I was a crypto long.
Yeah, I think, a lot of the kind of retracement there's been a huge amount of kind of whale wallet liquidations. So we've seen some big players liquidate a lot of their Bitcoin, which has contributed to that aggressive move down. And you can't write off that not happening again. It's one of those, a lot of Bitcoin is concentrated in a few wallets because it's had such an aggressive move up. So there's a lot of Bitcoin to be liquidated still.
Excellent. And on to the OIS, what the market's pricing for central bank movements over the next 12 months. The Fed, we mentioned 16 basis points of cuts priced for the next meeting. Not far off 12.5, 50-50. But there's just over 3 hikes priced over the next year, which is just 10 basis points from the ECB. Again, I think that's a bit lean. But what that has is the base rate in a year's time. The US, it has it at 3.1%, at 1.83 for the ECB. But again, if we get more signs of weak inflation in the ECB, I see them cutting more aggressively, even talk potential deflation next year. Another standout there, RBA, just 16 points of cuts priced. RBNZ 31. That has the terminal rates in Australia of 3.44%, in New Zealand at 2.19. That would have Aussie rates well over 1% above New Zealand. Historically, New Zealand's always been much higher. But again, they didn't hike rates as quickly. They had a huge housing bubble, and now the housing bubble actually is falling. One of the fastest countries it's falling in is New Zealand. So they are cutting rates particularly hard there. The Bank of Japan, 49 basis points of cuts priced over the next year.
Hikes.
Yep, sorry. That should be supportive of the yen, but of course, with the debt they have, the market's pretty nervous about touching that. Data for the next week, or this week. Coming Tuesday, we have the UK British Retail Consortium's retail sales. We also have UK employment data tomorrow. German ZEW, US ADP we will get, and National Federation of Independent Businesses Small Business Index. Wednesday, German inflation and the OPEC monthly report. Thursday, UK GDP, UK industrial production and Australian employment. On Friday, French inflation, US PPI we should be getting, even if the government is still in shutdown. And we also have 9 Fed speakers this week. Just before we go, just to remind you, we do now have some online training. We have Trading with Discipline, looking at technical analysis, fundamental analysis, and behavioral finance. This week, we also have a training course from Trading Gas, going live. In the next couple of weeks, we'll have trader psychology from our Formula One psychologist, Chris Gooder. And we also have the first full week of January, the 5th to the 9th. We have internal training for our traders. You can also join that. We have discounts online. Take a look at that. You can also email us for that. We had some internal training last week with new traders, and we had some external clients joining us for that. Do take a look, and we look forward to joining you next week. Thank you very much.
Thank you.
Thank you.
Hi everyone, I'm James Brodie, Head of Learning and Development here at Onyx Capital Group, and I'm delighted to welcome you to this immersive course on commodities and financial markets called Trading with Discipline, where we take a deep look into fundamental analysis, technical analysis, behavioural finance and risk management, all based on our one-day accredited programme with the Singapore Institute of Banking and Finance. Across a series of webinars, we'll explore the fundamentals of global markets, starting with an introduction to commodities and energy trading, before moving into key drivers of market prices through fundamental analysis. We'll also provide a clear overview of bonds, equities, and foreign exchange markets, ensuring you have a strong cross-asset understanding. We'll then dive into technical analysis, including trend following, mean reversion, risk management, and program trading strategies. We'll also examine the increasingly vital role of behavioral finance, helping you understand trader psychology and emotional discipline in real-world trading. The course includes interactive trading simulations powered by Amplify Me, multiple choice review tests throughout, a final end-of-course exam, and a certificate of completion. This program is ideal for anyone looking to develop a deeper understanding of financial markets, sharpen their trading instincts, and build real practical skills for the industry. I look forward to seeing you on the course.
Hello and welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Mita Chaturvedi and Quantitative Analyst Giovanni Simonetti. So each week, our fabulous research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by this wintertime and how much we just might end up paying, say, at the petrol station to fill up our cars ahead of the weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. In the next 30 minutes, we're going to be covering recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and a trade idea for the week. Watch out for that one. So with all that in mind then, Giovanni, firstly, let me ask you, what's been the big mover in crude oil futures this week?
Well, the story today has been the IEA has revised its forecast for global demand for gas and oil. So originally it had said that demand would start curbing and falling around 2030. But as we can now see from this chart here, the IEA has now forecasted oil to grow up until 2050. Now, originally from the chart, we can sort of see that they'd optimistically said 2025 is when oil would start, demand would start falling, but they've revised it last year to be 2030, and now they've just said, no, it's probably going to grow up till 2050. And this has very clearly been driven by the need for energy in AI data centers. We've also had some more news coming out from the Russian sanctions. So Lukoil, who had been previously massively impacted by these US sanctions on Russian companies, is now also in a bit of trouble in Iraq, where they are unable to access one of the largest oil fields, which happens to be one of the largest oil fields in the world. So they've literally they literally can't really do much with it right now. They're also in a bit of trouble in Bulgaria as well, where the Bulgarian government has taken over the largest refinery in there. So yeah, it's a bit of trouble coming ahead for Lukoil. We're also seeing some more news in the Middle East, where Saudi Arabia has announced their oil allocations for China, which has dropped quite a bit. It's the lowest since July 2024 at 36 million barrels, and it's dropped by about 3.5 million barrels compared to November. So this here is the Saudi allocations to China. So this is provided from the officials, and as we can see, December, there's a massive drop-off compared to the previous months. It still is only 500,000 barrels lower than December in the previous year, and the Q4 is still a stronger Q4 than Q4 in 2024.
Brilliant. So Mita, let's move on now then to refined products, if we may, because we've noticed over many, many months already, haven't we, that margins, they remain on the up. So what's the latest?
So as you said, refinery margins, that's the front month margins, have been their highest over the past year. As you can see on my chart over here, they've been steadily going up throughout this year, and a lot of this trend has emerged from the gas oil or diesel complex and from the gasoline complex. So starting with gas oil, so the front month swap crack has rallied to a high of $35 this week, where it met resistance, and it's currently around $33. The $34 is still $35 is still a very important level of resistance, so keep an eye on that. And this tightness is currently at among its highest level since 2022, which was the year Russia invaded Ukraine, and that led to a whole energy crisis after Western sanctions on Russia. So given that levels are now at similar levels to at that time of the year, there is a definite tightness that the market is pricing in right now, and a lot of this has been due to refinery outages in the east and among geopolitical risk from sanctions on Russian oil majors, especially with Gunvor's bid to buy Lukoil's international assets now falling through.
Actually, at this point then, Mita, let me just ask you to highlight some of those recent concerns around export tightness out of Asia. Tell us a little bit more about what's happening.
So right now we've got refinery maintenance and refinery outages in Asia, which has led to significant tightness from that region. And more recently, Chinese refiners have slashed their exports of gasoline, diesel, and jet fuel in November to 2.9 million metric tons. They may reduce this further to 2.36 million metric tons in December, and this compares to a Jan to Oct average. This is the monthly average for the rest from January to October of this year of 3.47 million metric tons. So fairly significant decline, and this decline has been due to export constraints out of the region. And so that may lead to further tightness as China slashes its exports. On the demand side for residential heating, which heating oil, which is also distillate, is often used for. Next week is expected to be colder in the UK, but in the US, signs are emerging that the Arctic polar vortex may weaken further into December, allowing frigid air to move southward, intensifying fears of colder weather. US distillate stocks relative to product supplied, so product supplied is a proxy for demand, currently stands at their lowest level except for during 2022 and 2023 for this time of the year. And further, so it'll be important to see the official US stock data over the next few weeks. Tomorrow's is going to be the most recent, is going to be this week's data. It's going to be important to see if we see further stock draws. If that's the case, then refining margins could stay supported. On the gasoline side of things, we will talk about gasoline further in the show as well. But for now, they've remained very well supported for this time of the year. As you can see on this next chart over here, that's the front month EBOB crack. EBOB is European gasoline, and levels are, well, that's the white lines 2025, and levels are very comfortably above previous years for this time of the year. So wintertime normally sees a decline in gasoline as demand is a lot lower than compared to the summer when everyone's out driving. But that's just not the case this year. Everyone's buying at these really high levels. We initially saw some flurries of bearishness in the physical ARA, that's the Amsterdam, Rotterdam, Antwerp barges, that's the physical European gasoline window, but that also got bought into, and there seems to be good buying flow at this level.
All right, thanks for that, Meeta. Giovanni, let's move on now, if we may, and talk a little more about the futures market. Have there been any interesting changes in positioning recently?
Oh, yes, they have. So over the past few weeks, we've definitely had some interesting stories to tell in positioning. But before we start, let me just say about the CFTC data. So obviously, the CFTC data, we've only been able to see the ICE data, so only European data. All of the US-related data, we've not been able to see any of that because of the government shutdown. So hopefully within the next few weeks, as the government reopens, we should start seeing other futures positioning as per the CFTC. Now, if we take a look at this chart, we can actually see what's happened, at least in the Brent complex position-wise. So we see on the 21st of October, when we had this huge glut narrative, there was a lot of short positioning, especially in the money managed positions. And then at the week immediately after, the one on the 28th of October, that is when Trump announced further sanctions on Russia, and we saw a lot of these short positions get stopped out. This week, we've just seen the shorts just like return to normal levels after they were quite stopped out last week. Same goes for producer merchant, where we just about see open interest reduce, and we can quite clearly see in both the long and short position reducing here. Overall, open interest fell about 2% over the week, but it still remains 30% above the 5-year average and 8% above the 5-year max. Now, if we look at the next chart, we can have a look at gas oil, which has also had a bit of change in positioning as well. We've seen mainly the longs have increased. Overall, both long and short position have increased, but overall it's just been long as gas oil market has been quite bullish recently, and this positioning chart here just basically tells us that people just contribute to this bullish momentum in gas oil.
And Giovanni, we know that official COT data, of course, lagged by a week, isn't it? So what does Flux's timelier positioning data, I'm feeling, tell us? What does it tell us?
So basically, now if we have a look at our chart, the CTA chart, this is our proprietary CTA model. we can have a look at how all the various futures are positioned. And again, same as with the past few weeks, we've just been seeing how heating oil and gas oil, these are the orange and purple lines in this chart, are quite severely overpositioned. So last week we'd already started talking about how, because they're so overpositioned, they're literally in the danger zone here in the red area. We were talking about how they could, there's a high likelihood of them mean reverting down. And we looked at it quite interestingly in the gas oil crack. So the gas oil versus Brent was the widest it's ever been, and we were expecting them to revert down. However, we've just seen quite the opposite of just gas oil continuing this trend in the danger zone, and Brent, on the other hand, is just like had a tiny bit of a dip position-wise, as we've even highlighted in some of the previous charts. But yeah, I'm a bit cautious to say that we're going to see mean reversal. I'm not going to say it until we start seeing any of either the gas oil, the heating oil start approaching the lower end of this danger zone.
There you go, great insight. Let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract that's, for you, Mita, stood out?
Yes, so the gasoline market has in its entirety stood out for me, but I'm going to concentrate on the transatlantic ARB, so that is the M1 transatlantic gasoline ARB, which reflects the flow of gasoline from Northwest Europe into the US. So this ARB, for the purposes of people watching our show for the first time, is RBOB gasoline, that is US gasoline, minus EBOB gasoline, European gasoline. And as you can see over here on our chart, this is currently for the specific DEC 25, so it's, and the seasonal chart compares it to previous years for the DEC contract. It's currently at its lowest level. So the TA ARB has been incredibly weak since the start of September, and this has been alongside a strengthening EBOB complex pressuring the ARB down. And the EBOB complex remains relentless. We continue to see sell-side interest in the ARB as a result. We briefly saw support in the contract in the ARB, that is, towards the end of October into November. This was around the time we saw refinery outages in the US, which strengthened RBOB relatively more than EBOB. And then at this time, our data showed open interest increase in the contract, and trade houses came in and started selling the ARB, defending their positions, which I assume would also be a good way to enter long EBOB, considering the rise in open interest in EBOB. It might be a safer way for them to get long EBOB, which is interesting. However, if you look at this next chart over here, we now see open interest declining. With prices coming off, this could be due to long players taking off their positions, not to cut their losses. That's fairly exciting.
So how then is the market position now, would you say? What's your view on this contract based on this?
So as I said, trade houses remain good sellers against Onyx, and refiners as well, as you can see on this next chart over here. So as you can see over here, trade houses and refiners have been selling. Refiners likely hedge positions, since selling the ARB reflects their physical exposure to the route. We saw trade houses briefly trim some of their positions this week as you can see, but on 11th November, we saw them add to their shorts again. If you go over to the next chart, we see good selling down the curve as well. That's red being short positions against Onyx. That down the curve, we just see good selling, especially in the Q2 region, where we have seen nearly 1.2 million barrels of trade house and refiner selling. The Q2 ARB, that is the second quarter of 2026 ARB, is currently around 50 cents per gallon. We could still see selling at these levels. The ARB is fairly wide open.
Just taking a break then from positioning data, shall we dive into another really interesting way of analysing the market through the means of technical analysis, which uses statistical trends, doesn't it, gathered from past data to derive insights from the market? Mita, could you just talk us through any interesting shifts in the market, technically speaking?
Yes, I can. So we're going to start with Brent futures. So in Brent futures over here, and this week in our Brent forecast, we predicted a breakout in the futures contract after it had been oscillating around those two white lines that you see on our chart here. So those two white lines, that downward trend channel reflects a consolidation that often is a setup for a breakout in either direction. So the gap up that we saw in the futures market before that is what technical analysts, coupled with the downward channel, is what we call a flag. So it's like a flagpole and then the flag right there. And the flag represents a pause in the in the trend, and it's meant to signal that this trend is going to continue. So the flag pole is going to continue on the other side of the flag. So it's a nice little image for you. But right now we did see that breakout yesterday. We see that bullish candlestick piercing through that buy channel, but that has been capped by a very significant resistance level. That is the blue line on my chart, the 50-day moving average. So now the 50-day moving average has been fairly important in previous, if you look at the chart in previous levels as well, around the start of October. Momentum is still positive. That's shown by the second panel on that chart over there. It's still in the green, but it is fairly stagnant this week. Considering the momentum is still positive, it could be interesting to see if levels hold up. If not, if the 50-day moving average continues to be important resistance, we could see support around those two white lines, with further support around the $60. That's a very significant support around the $60 handle.
And you wanted to take us through gas oil?
Yes, gas oil as well. So the next chart shows the same thing for gas oil, the gas oil swap crack. This is the rolling month-to-month gas oil swap crack. As Giovanni and I have mentioned, there is a lot of bullishness in this contract, and it has pierced through previous highs this year. The second panel over there shows momentum, very much in the green, but that pink line over there currently at around 35. So when that pink line is above 20, that shows a strong trend in the market. So with the green line, with momentum being positive and that pink line being at 35, we see a strong bullish trend in the market. However, it is interesting that we see key resistance at the 38.2% Fibonacci retracement level from 2022's high above $60 and low of below $14 at the end of April 2023. $34 is also an important resistance level from 2024. So these levels will be really important to watch for the market. Support from here, should we go lower, would be at $30 and at $28 based on recent lows. The RSI, which is the third panel on that chart, has failed to make a higher high despite prices breaking to a higher high, which is a bearish divergence. Another thing to keep an eye on. Momentum is still fairly positive, and it's usually not advised to go against that in technical analysis, but the RSI waning compared to price is definitely a pretty bad flag.
Thanks, both of you. We've learnt so much already in our latest session. Now, though, I'm just going to put you both on the spot because it is our crystal ball prediction moment. I love it. So where do you see them, particularly Brent, going in the coming week? And give us, too, your top trade tip.
Well, in terms of Brent, I can't really see it breaking further than this 60-65 level. I think there's plenty of support around the 63 to 64.50, which we've been seeing all week. So I'm just going to be, in my opinion, Brent is going to stay within this level. I can't really see it going further above or even dipping below 60 anytime soon. So my prediction is around this. How about you, Mita?
Giovanni's taken the technical view. It's going to not go above that blue line, not go below that white line. But I do see his point. I do see it difficult for Brent to break above 65, 66, especially over here. I find it interesting that the IEA came out with this whole oil demand will continue to increase, and Brent spreads have not really reacted. There is meant to be a lot of hope from the US shutdown potentially ending. We don't even know if that's going to happen this week or the week after. We don't know anything about that yet. And we already have seen a good deal of geopolitical risk being priced in, and it feels a lot like we've made our move. I don't really see it going further up unless we see Trump saying something completely ridiculous by the end of this week. So I do agree that I think we've reached a bit of a cap, and we could maybe go down to 63.
We've got a last couple of charts, haven't we?
As you mentioned, our top trade tip for the week. Our trade idea in this week's Alpha report, which was on Monday, was to buy the Prom DFL roll, and I find it still really interesting, so I'm going to talk about that. So Brent spreads have seen a large correction recently, giving up most of their post-sanctions gains, as I've just said, in our crystal ball moment. So traders have turned towards largely anticipated oil supply glut. The front Jan-Feb futures fell significantly this week. while the prompt dated rolls in November have been in contango. Contango being that the spot market is a lot cheaper than the futures market. However, we are a lot more optimistic towards December structure in dated Brent, given supportive crude fundamentals in the near term. TD25 freight, that is the freight route from US Gulf to ARA, is fairly elevated, which may reduce the amount of WTI landing in Europe, which could be a good supply side factor for some strength in December. In addition, refinery margin strength remains a bullish factor. If profit margins are fairly high for refiners, they are going to want more crude, especially in the winter. I think the winter time is also important because we've had so much discussion of refinery outages. I feel like I've said that word like 10 times in this show, but that's we should start seeing refineries come out of maintenance around December. So that should be interesting to keep an eye out, like what that means for crude demand. December rolls, as I mentioned, remain in backwardation, and with 8 to 12 December onwards, noting refiner and trade house buying. Although prices have been trending lower, we have seen them hit a floor, as you can see over here, and around the 10 cents level and go up, and they're currently around the 20 cent level. We see a little more upside from here. We're targeting around the 30 cent region, but we do recommend keeping a tight stop loss at this level.
Thank you very much. And that is it for this week's Flux Insight Show. I hope you've enjoyed it and learned a lot. I certainly have. Huge thanks, of course, now to our fabulous research team, Mita and Giovanni. Thank you. And remember, for a deeper dive into our research and data offerings, you can visit flux.live, and feel free, of course, as well, to reach out to us with any questions and comments. So, see you all next time.
difference between gambling and taking risks. So in my understanding, the way I see it is gambling is you're just betting without any kind of edge whatsoever. Whereas taking risk in trading, there's the old phrase of like stacking probabilities.
Well, that's James King.
Yeah, James King, right? Stacking probabilities in your favor. Like that's what you're trying to do. And when you have done the preparation and the work that's necessary, you can go big. You can go, if you've built a strategy with a great expectancy, good win-loss. When you win more than what you lose. I mean, when you have good metrics, by all means maximize that strategy as much as possible. But that doesn't mean you just go, okay, I need to make money, let me go and buy some flat price.
Bakary, thanks for doing this. I know you hate this kind of stuff, but
very uncomfortable. Well, gonna have to deal with it.
We'll just start with a quick fire round. Probably quite a lot of people do know you in the Dubai market. That's where you trade. That's where you traded for about 10 years now. But as it is with the industry, like there's all these niches, right? So summarizing it, your career being how long in oil trading?
Since 2015, end of 2015, so that takes us right about the 10-year mark.
Yeah, and always been Dubai crude really in oil.
So when I started off, I did the usual kind of rotations.
Yeah.
It took me a bit to find my niche. So I traded a little bit of fuel, a little bit of brief period in naphtha, distillates, but I always kind of found my way back to Dubai.
You started with me, right?
Yeah.
Yeah, it's good times. And you always used to get shit for not marking your curve at the back. It was just not really your style. Chimming in and out. So I guess before we get into like more of the detail, just summarizing, like how would you, and I know this has evolved, but if you had to very quickly summarize your trading philosophy.
So in terms of how I trade, I trade, especially now, predominantly systematically. So all of my trading is very process-based. That wasn't always the case. Let's say 5 years ago, there was a lot more room for discretionary trading in the market, for day trading in general. As the market has evolved, I've also kind of moved a little bit towards slightly longer term, more signal-based trading. So I'd probably say I trade medium-term momentum with a variety of signals based on flows. So, just
Hello and welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Mita Chaturvedi and Quantitative Analyst Giovanni Simonetti. So each week, our fabulous research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by this wintertime and how much we just might end up paying, say, at the petrol station to fill up our cars ahead of the weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. In the next 30 minutes, we're going to be covering recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and a trade idea for the week. Watch out for that one. So with all that in mind then, Giovanni, firstly, let me ask you, what's been the big mover in crude oil futures this week?
Well, the story today has been the IEA has revised its forecast for global demand for gas and oil. So originally it had said that demand would start curbing and falling around 2030, but as we can now see from this chart here, the IEA has now forecasted oil to grow up until 2050. Now, originally from the chart, we can sort of see that they'd optimistically said 2025 is when oil would start, demand would start falling, but they've revised it last year to be 2030, and now they've just said, no, it's probably going to grow up until 2050. And this has very clearly been driven by the need for energy in AI data centers. We've also had some more news coming out from the Russian sanctions. So Lukoil, who had been previously massively impacted by these US sanctions on Russian companies, is now also in a bit of trouble in Iraq, where they are unable to access one of the largest oil fields, which happens to be one of the largest oil fields in the world. So they've literally they literally can't really do much with it right now. They're also in a bit of trouble in Bulgaria as well, where the Bulgarian government has taken over the largest refinery in there. So yeah, it's a bit of trouble coming ahead for Lukoil. We're also seeing some more news in the Middle East, where Saudi Arabia has announced their oil allocations for China, which has dropped quite a bit. It's the lowest since July 2024 at 36 million barrels, and it's dropped by about 3.5 million barrels compared to November. So this here is the Saudi allocations to China. So this is provided from the officials, and as we can see, December, there's a massive drop-off compared to the previous months. It still is only 500,000 barrels lower than December in the previous year, and the Q4 is still a stronger Q4 than Q4 in 2024.
Brilliant. So Mita, let's move on now then to refined products, if we may, because we've noticed over many, many months already, haven't we, that margins, they remain on the up. So what's the latest?
So as you said, refinery margins, that's the front month margins, have been their highest over the past year. As you can see on my chart over here, they've been steadily going up throughout this year, and a lot of this trend has emerged from the gas oil or diesel complex and from the gasoline complex. So starting with gas oil, so the front month swap crack has rallied to a high of $35 this week, but it met resistance and it's currently around $33. The $34 is still $35 is still a very important level of resistance, so keep an eye on that. And this tightness is currently at among its highest level since 2022, which was the year Russia invaded Ukraine, and that led to a whole energy crisis after Western sanctions on Russia. So given that levels are now at similar levels to at that time of the year, there is a definite tightness that the market is pricing in right now, and a lot of this has been due to refinery outages in the east and among geopolitical risk from sanctions on Russian oil majors, especially with Gunvor's bid to buy Lukoil's international assets now falling through.
Actually, at this point then, Mita, let me just ask you to highlight some of those recent concerns around export tightness out of Asia. Tell us a little bit more about what's happening.
So right now we've got refinery maintenance and refinery outages in Asia, which has led to significant tightness from that region. And more recently, Chinese refiners have slashed their exports of gasoline, diesel, and jet fuel in November to 2.9 million metric tons. They may reduce this further to 2.36 million metric tons in December, and this compares to a Jan to Oct average. This is the monthly average for the rest from January to October of this year of 3.47 million metric tons. So fairly significant decline, and this decline has been due to export constraints out of the region. And so that may lead to further tightness as China slashes its exports. On the demand side for residential heating, which heating oil, which is also distillate, is often used for. Next week is expected to be colder in the UK, but in the US, signs are emerging that the Arctic polar vortex may weaken further into December, allowing frigid air to move southward, intensifying fears of colder weather. US distillate stocks relative to product supplied, so product supplied is a proxy for demand, currently stands at their lowest level except for during 2022 and 2023 for this time of the year. And further, so it'll be important to see the official US stock data over the next few weeks. Tomorrow's is going to be the most recent, is going to be this week's data. It's going to be important to see if we see further stock draws. If that's the case, then refining margins could stay supported. On the gasoline side of things, we will talk about gasoline further in the show as well. But for now, they've remained very well supported for this time of the year, as you can see on this next chart over here. That's the front month EBOB crack. EBOB is European gasoline, and levels are, well, that's the white lines 2025, and levels are very comfortably above previous years for this time of the year. So wintertime normally sees a decline in gasoline as demand is a lot lower than compared to the summer when everyone's out driving. But that's just not the case this year. Everyone's buying at these really high levels. We initially saw some flurries of bearishness in the physical ARA, that's the Amsterdam, Rotterdam, Antwerp barges, that's the physical European gasoline window, but that also got bought into, and there seems to be good buying flow at this level.
All right, thanks for that, Meeta. Giovanni, let's move on now, if we may, and talk a little more about the futures market. Have there been any interesting changes in positioning recently?
Oh, yes, they have. So over the past few weeks, we've definitely had some interesting stories to tell in positioning. But before we start, let me just say about the CFTC data. So obviously, the CFTC data, we've only been able to see the ICE data, so only European data. All of the US-related data, we've not been able to see any of that because of the government shutdown. So hopefully within the next few weeks, as the government reopens, we should start seeing other futures positioning as per the CFTC. Now, if we take a look at this chart, we can actually see what's happened, at least in the Brent complex position-wise. So we see on the 21st of October, when we had this huge glut narrative, there was a lot of short positioning, especially in the money managed positions. And then at the week immediately after, the one on 28th of October, that is when Trump announced further sanctions on Russia, and we saw a lot of these short positions get stopped out. This week, we've just seen the shorts just like go back to return to normal levels after they were quite stopped out last week. Same goes for producer merchant, where we just about see open interest reduce, and we can quite clearly see in both the long and short position reducing here. Overall, open interest fell about 2% over the week, but it still remains 30% above the 5-year average and 8% above the 5-year max. Now, if we look at the next chart, we can have a look at gas oil, which has also had a bit of change in positioning as well. We've seen mainly the longs have increased. Overall, both long and short position have increased, but overall it's just been long as gas oil market has been quite bullish recently, and of just this positioning chart here just basically tells us that people just contribute to this bullish momentum in gas oil.
And Giovanni, we know that official COT data, of course, lagged by a week, isn't it? So what does Flux's timelier positioning data, I'm feeling, tell us? What does it tell us?
So basically, now if we have a look at our chart, the CTA chart, this is our proprietary CTA model. We can have a look at how all the various futures are positioned. And again, same as with the past few weeks, we've just been seeing how heating oil and gas oil, these are the orange and purple lines in this chart, are quite severely overpositioned. So last week we'd already started talking about how, because they're so overpositioned, they're literally in the danger zone here in the red area. We were talking about how they could, there's a high likelihood of them mean reverting down. And we looked at it quite interestingly in the gas oil crack. So the gas oil versus Brent was the widest it's ever been, and we were expecting them to revert down. However, we've just seen quite the opposite of just gas oil continuing this trend in the danger zone, and Brent, on the other hand, has just like had a tiny bit of a dip position-wise, as we've even highlighted in some of the previous charts. But yeah, I'm a bit cautious to say that we're going to see mean reversal. I'm not going to say it until we start seeing any of either the gas oil, the heating oil start approaching the lower end of this danger zone.
There you go, great insight. Let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract that's, for you, Mita, stood out?
Yes, so the gasoline market has in its entirety stood out for me, but I'm going to concentrate on the transatlantic ARB, so that is the M1 transatlantic gasoline ARB, which reflects the flow of gasoline from Northwest Europe into the US. So this ARB, for the purposes of people watching our show for the first time, is RBOB gasoline, that is US gasoline, minus EBOB gasoline, European gasoline. And as you can see over here on our chart, this is currently for the specific DEC 25, so it's, and the seasonal chart compares it to previous years for the DEC contract. It's currently at its lowest level. So the TA ARB has been incredibly weak since the start of September, and this has been alongside a strengthening EBOB complex pressuring the ARB down. And the EBOB complex remains relentless. We continue to see sell-side interest in the ARB as a result. We briefly saw support in the contract in the ARB, that is, towards the end of October into November. This was around the time we saw refinery outages in the US, which strengthened RBOB relatively more than EBOB. And then at this time, our data showed open interest increase in the contract, and trade houses came in and started selling the ARB, defending their positions, which I assume would also be a good way to enter long EBOB, considering the rise in open interest in EBOB. It might be a safer way for them to get long EBOB, which is interesting. However, if you look at this next chart over here, we now see open interest declining. With prices coming off, this could be due to long players taking off their positions, not to cut their losses. That's fairly exciting.
So how then is the market positioned now, would you say? What's your view on this contract based on this?
So as I said, trade houses remain good sellers against Onyx, and refiners as well, as you can see on this next chart over here. So as you can see over here, trade houses and refiners have been selling. Refiners likely hedge positions, since selling the ARB reflects their physical exposure to the route. We saw trade houses briefly trim some of their positions this week, as you can see. But on 11th November, we saw them add to their shorts again. If you go over to the next chart, we see good selling down the curve as well. That's red being short positions against Onyx. That down the curve, we just see good selling, especially in the Q2 region, where we have seen nearly 1.2 million barrels of trade house and refiner selling. The Q2 ARB, that is the second quarter of 2026 ARB, is currently around 15.50 cents per gallon. We could still see selling at these levels. The ARB is fairly wide open.
Just taking a break then from positioning data, shall we dive into another really interesting way of analysing the market through the means of technical analysis, which uses statistical trends, doesn't it, gathered from past data to derive insights from the market? Mita, could you just talk us through any interesting shifts in the market, technically speaking?
Yes, I can. So we're going to start with Brent futures. So in Brent futures over here, and this week in our Brent forecast, we predicted a breakout in the futures contract after it had been oscillating around those two white lines that you see on our chart here. So those two white lines, that downward trend channel reflects a consolidation that often is a setup for a breakout in either direction. So the gap up that we saw in the futures market before that is what technical analysts, coupled with the downward channel, is what we call a flag. So it's like a flagpole and then the flag right there. And the flag represents a pause in the trend, and it's meant to signal that this trend is going to continue. So the flagpole is going to continue on the other side of the flag. So it's a nice little image for you. But right now we did see that breakout yesterday. We see that bullish candlestick piercing through that buy channel, but that has been capped by a very significant resistance level. That is the blue line on my chart, the 50-day moving average. So now the 50-day moving average has been fairly important in previous, if you look at the chart in previous levels as well, around the start of October. Momentum is still positive. That's shown by the second panel on that chart over there. It's still in the green, but it is fairly stagnant this week. Considering the momentum is still positive, it could be interesting to see if levels hold up. If not, if the 50-day moving average continues to be important resistance, we could see support around those two white lines, with further support around the $60. That's a very significant support around the $60 handle.
And you wanted to take us through gas oil?
Yes, gas oil as well. So the next chart shows the same thing for gas oil, the gas oil swap crack. This is the rolling month gas oil swap crack. As Giovanni and I have mentioned, there is a lot of bullishness in this contract, and it has pierced through previous highs this year. The second panel over there shows momentum, very much in the green, but that pink line over there currently at around 35. So when that pink line's above 20, that shows a strong trend in the market. So with the green line, with momentum being positive and that pink line being at 35, we see a strong bullish trend in the market. However, it is interesting that we see key resistance at the 38.2% Fibonacci retracement level from 2022's high above $60 and low of below $14 at the end of April 2023. $34 is also an important resistance level from 2024. So these levels will be really important to watch for the market. Support from here, should we go lower, would be at $30 and at $28 based on recent lows. The RSI, which is the third panel on that chart, has failed to make a higher high despite prices breaking to a higher high, which is a bearish divergence. Another thing to keep an eye on. Momentum is still fairly positive, and it's usually not advised to go against that in technical analysis, but the RSI waning compared to price is definitely a pretty bad flag.
Thanks, both of you. We've learnt so much already in our latest session. Now, though, I'm just going to put you both on the spot because it is our crystal ball prediction moment. I love it. So where do you see them, particularly Brent, going in the coming week? And give us, too, your top trade tip.
Well, in terms of Brent, I can't really see it breaking further than this 60-65 level. I think there's plenty of support around the 63 to 64.50, which we've been seeing all week. So I'm just going to be, in my opinion, Brent is going to stay within this level. I can't really see it going further above or even dipping below 60 anytime soon. So my prediction is around this. How about you, Mita?
Giovanni's taken the technical view. It's going to not go above that blue line, not go below that white line. But I do see his point. I do see it difficult for Brent to break above 65, 66, especially over here. I find it interesting that the IEA came out with this whole oil demand will continue to increase, and Brent spreads have not really reacted. There is meant to be a lot of hope from the US shutdown potentially ending. We don't even know if that's going to happen this week or the week after. We don't know anything about that yet. And we already have seen a good deal of geopolitical risk being priced in, and it feels a lot like we've made our move. I don't really see it going further up unless we see Trump saying something completely ridiculous by the end of this week. So I do agree that I think we've reached a bit of a cap, and we could maybe go down to 63.
We've got a last couple of charts, haven't we?
As you mentioned, our top trade tip for the week. Our trade idea in this week's Alpha report, which was on Monday, was to buy the prompt DFL roll, and I find it still really interesting, so I'm going to talk about that. So Brent spreads have seen a large correction recently, giving up most of their post-sanctions gains, as I've just said, in our crystal ball moment. So traders have turned towards largely anticipated oil supply glut. The front Jan-Feb futures fell significantly this week, while the prompt dated rolls in November have been in contango. Contango being that the spot market is a lot cheaper than the futures market. However, we are a lot more optimistic towards December structure in dated Brent, given supportive crude fundamentals in the near term. TD25 freight, that is the freight route from US Gulf to ARA, is fairly elevated, which may reduce the amount of WTI landing in Europe, which could be a good supply side factor for some strength in December. In addition, refinery margin strength remains a bullish factor. If profit margins are fairly high for refiners, they are going to want more crude, especially in the winter. I think the winter time is also important because we've had so much discussion of refinery outages. I feel like I've said that word like 10 times in this show, but that's we should start seeing refineries come out of maintenance around December. So that should be interesting to keep an eye out, like what that means for crude demand. December rolls, as I mentioned, remain in backwardation, and with 8 to 12 December onwards, noting refiner and trade house buying. Although prices have been trending lower, we have seen them hit a floor, as you can see over here, and around the 10 cents level and go up, and they're currently around the 20 cent level. We see a little more upside from here. We're targeting around the 30 cent region, but we do recommend keeping a tight stop loss at this level.
Thank you very much. And that is it for this week's Flux Insight Show. I hope you've enjoyed it and learned a lot. I certainly have. Huge thanks, of course, now to our fabulous research team, Mita and Giovanni. Thank you. And remember, for a deeper dive into our research and data offerings, you can visit flux.live, and feel free, of course, as well, to reach out to us with any questions and comments. So, see you all next time.
Good afternoon, and welcome to another episode of the European Market on Close. Let's dive quickly to see what happened in the North Sea. So Vitol was once again offering, as we can see here on the table, they were offering Midland and the 40s. So Moeve and Exxon both came and lifted Vitol's offers for 1 to the 5th December at 25 cents here. Vitol remained very consistent on these offers, which should slightly shift our Midland curve down in the belly. Compared to yesterday, but 40s is the big deal here. 40s was traded because Total lifted the Vitol's offer for the 1 to 5th December at just 20 cents overdated, and that's a SIF. So when we are talking free on board terms, we're talking about minus 90, minus 95 cents, because remember, freight is very expensive right now. So that should bring the physical differential slightly down today, or relatively unchanged. Yesterday, we moved slightly up to minus 87 cents. We had a big change, especially in Midland, because of some buys that occurred yesterday. And today we should remain pretty stable around this area here that we see on the chart. Minus 87, minus 88 cents. That should be our physical differential, which the officials team is assessing at the back right now. Now, if we were to move into price action. So flat price, we had EIA stats. Flat price has been very resilient, currently trading around $63 in the low 63, 63.25. But Brent spread is the story here, because quite frankly, we're trading around 34, 35 cents. And that's pretty high compared to the subdued levels we had early this morning. So from memory, if you remember, we're trading around 20, 25 cents, and we had a mini rally up 10 cents on the day, around 35, 34 at the time of speaking. But if we were to move at WTI, the same spread, January, February, is actually holding very soft, but it's gained slightly. And remember, the EIA stats were bullish for cashing. We had a draw of 350,000 barrels in cashing. But on crude overall, the news were bearish, because we had stocks were up 6.4 million barrels week on week. And on products, of course, that should imply more demand on the other side, because distillates were down 640,000 barrels, while gasoline was down, gasoline stocks were down almost 1 million barrels week on week. Now, another interesting news in the market, we're hearing from various sources that Litasco is currently firing their employees from Geneva, Dubai, Houston, all across the world pretty much. And that comes after the sanctions that were imposed by Trump and his right hands. So the question is, what's happening with the trades? Are there any active trades right now? And what's happening with the counterparties? That's an ongoing discussion. We're speaking to our sources, and obviously you learn everything at the officials on our Twitter account, on our LinkedIn, and obviously the Flux News YouTube channel, where you can find the latest news. Until then, have a lovely evening and see you tomorrow. Thank you very much.
you.